Morning, everyone. This is Rajendran here, joining from Market Calls, and welcome everyone to zila 2.0, a comprehensive mentorship program on Discover Your Trading Edge. So, before getting into the program, just give me a quick confirmation on the audio and video quality so that we can kickstart with the session. Okay, great. Thanks, Vishal. Okay. So thank you then. We are good to go then. Okay, so about myself, my name is Rajendran. I'm the one who write about markets, market analysis, trading strategies, and market calls. I'm writing quite since 2007 onwards, and most of my expertise is in market profile, order flow analytics, trading system indicator development, and automated trading. And I had trained closely more than 500 plus professional traders. Some of them are from the institutional side, some of them are from prop desk, and some of them are from the retail trading community, right? And I primarily use softwares like Ninja Trader. Mostly, I prefer using Ninja Trader for two reasons. One is for market profile and order flow. Otherwise, I'm more of an systematic trader. I use Ami Broker mostly, and my nature of the trading is mostly related to speculative bets in the markets. At times, it will be highly risky, and I'm mostly oriented on directional trades. Right? So I don't do option writing, or I don't do straddles, strangles kind of option strategies. I'm more of an directional player in the markets. I do know option writing, but primarily I am focused more on the directional approach, right? And I do hedge my trades as well. And this program, this training program is all about. It's all I can guarantee you is it is an institutional grade trading skill development program, and it helps you to understand the markets better, ability to get the context better, and thereby mostly will be moving in an objective manner. So we'll be making decisions in objective manner. We have a clear cut rules, when to enter, when to exit, and how we have to position ourselves in the market. Should I have to do a trend following today, or should I have to do an position sizing today? Should I have to add to my positions, or should I have to do a mean reversion today? It's kind of a dynamic approach. Whatever we are going to talk in this session is going to be a dynamic approach, which helps you to step up from your current scenario to the next level of trading, I would say that. And it brings you the ability to analyze any asset classes, not only to analyze but also to trade any asset classes. Let it be an index, let it be stocks, let it be commodities, currencies, crypto, let it be anything. The program is designed in such a way that you can trade any kind of market situations. Like it could, let it be an high volatile, low volatile, sideways markets, or trending markets. So let it be any kind of markets. You'll be able to understand what kind of environment currently we are in. Is the environment changed, or how we can adapt to the dynamic changing market environments. That's what the whole theme of TradeZilla 2.0 is all about. And the tools, what I'm going to use here are Ninja Trader 8 platform, because previously in our previous sessions we used Ninja Trader 7. Now Ninja Trader 8 is much superior compared to Ninja Trader 7 platform. And we will be using two versions of Market Profile. The Bell Market Profile Pro, I guess most of the people would have access to the basic version. And also we'll be using the Bell Market Profile Ultimate edition, which comes with an scanners and premium automated reference lines as well. Next comes the TradeZilla 2.0. It's a trader's worksheet. It is a worksheet which I want you to practice on day-to-day trading. When it comes to day-to-day trading, you have to initially you need to have to fill all these worksheets to understand. It's kind of a checklist. I would say that it's kind of a trader's checklist to make sure that you are getting the context right, to make sure that You are finding the patterns right to make sure that what I am seeing, you're also seeing the same information, right? So it has been prepared in such a way. And I, yeah, I mean, as a part of the program, you will be getting access to the recorded webinar access. The current webinar is getting recorded. You'll be getting access to it, and all the links has been shared to you in your email. You will also have access to the past recorded videos, right? Again, you can check your email today. I mailed before starting the session here. All these recorded webinar access closely cover more than 300 plus hours of 300 400 hours of recorded webinar, where it helps you to see how we've seen the markets in the past. And you're also able to get access to market profile and order flow premium articles, which we used to write in market calls time to time, about if there is any signature trades which is coming in, or if there is any new concepts which is developing, we'll be posting you that access. You again, you will be getting for 1 year. And Slack, of course, it's our own private trading community. Closely 500 plus members are there. The people who trained, the members in Slack are mostly trained by me, and some of them are experts in market profile and order flow as well. Some of them are experts in option writing. You can find many experts over there: price action experts, Elliott wave experts. Multiple experts are there, and even some of them are from institutional side as well, right? So that access is lifetime. So it's this is where our most of our conversation happens during the market hours, post the market hours, anything related to market profile and order flow. Most of the communication happens over here. If you have questions, or post the session, if you have any questions, you're always invited to go and post in the community over there. If you feel a bit shy, still we have one-to-one conversation. Like, you can do a direct message to me, and you can still we can do a one-to-one conversation. But if you want to have a community support, if you want someone to answer, it's not just me, but if you want to come and answer, we have a Slack channels. It's a classified channels. I guess most of you people have onboarded to Slack, but if you still haven't onboarded to Slack, just accept the invitation which is sent by my team. If you still haven't feel like you haven't got any accept invitation, just go back and connect with my support team. They will be happy to assist you on onboarding you to Slack, right? And you'll also be entitled to the Slack community webinars, which we do once in a month or twice in a month. And the follow through webinars post the session will be there, so which will help you to assess your market profile skills periodically, and able to improve your market profile skills periodically. So these are the takeaway from TradeZilla 2.0. And the basic prerequisites, these are the mandatory basic prerequisites. You need to have a strong, the basic understanding about futures and options. Right? I believe the one who are attending the session here today are not the newbies in the markets. I assume that they are not 1 or 2 months or 3 months experience in the markets. If you are, then go and grab the basics of futures and options concepts, right? So, and what I need is a strong time commitment to active market observations, like which is very critical for learning market profile and order flow skills, and the curiosity to learn newer and radical concepts. I would say that market profile and order flow are completely radical concepts, right? So which will help you to sharpen your market understanding. At the same time, it helps you to understand your competition better. And willingness to spend more on screen time. These are the basic requisites which is required for market profile and order flow. It's not just for market profile and order flow, but any other technical analysis. If you want to learn deeper, one thing which is mostly undervalued is the screen time, right? So a good screen time, the more the screen time you have, higher the ability to adapt to any kind of market, changing market situations, ability to deal with your psychological issues with the markets, right? So let's not delay further. Let's quickly get into market profile and order flow, right? So in today's session, we're going to deal with the basics of market profile, right? And we'll be covering order flow concepts as well in depth. So I guess you would have received the agenda today. So go back to your PPTs and go through the agenda and stick to the agenda. We'll be following the agenda, and we'll be sticking to the agenda the uh, as per the PPTs whichever I shared. And if there are any changes, it will be intimated to you. Right? So how do I see market profile and order flow? So I would say that the market profile and order flow are a completely radical approach to the markets to grab edge in this new gen technological field, right? So I see market profile and order flow as an three different entities. One is I see market profile as a game theory. Like game theory talks about what the uh, it talks about the participants. In terms of markets, it deals with the how the other players behave, how the other participants behave in the market. It's more of a behavioral approach. Likewise, market profile is also a behavioral approach where it talks about what kind of participants are coming into the markets, right? So, and what is their participation behavior? If they are intraday players, what is their behavior? How they behave? How an intraday players behave? When I say intraday players, I'm not talking about one individual intraday players. I'm talking about the layers of intraday players. Uh, how the short-term players behave, how the institutional traders behave, how the long-term traders behave, right? So when you know the such kind of behavioral approach, how we can take advantage of those information. That's what game theory deals with. That's what exactly market profile is also deals with. And just like the Google GPS, which keeps you informed about directions on each and every turn, it's like a nice, sweet voice. In a lady tone, it tells you that next 100 meters, you turn right. Another, you go straight 1.7 kilometers, right? Take a U-turn, right? So take a left turn. It keeps you informed about the direction at the appropriate places, right? So exactly that's what market profile is also do. Market profile doesn't gives you buy and sell signal. It will not tell you where to buy and where to sell, but you over a period of time will be developing a framework, will be developing a concept which helps you to approach the markets whichever the direction the markets are willing to move, right? So, and it also helps you to take a quicker turn. It also helps you to take an uh, very short-term moves, when to take such in a short-term moves. It helps you, the framework which I built on top of market profile, it helps you to take such kind of an informed decisions about the market directions. And just like machine learning, right? Machine learning is all about making a better continuous learning. The machine learning, it always looks into the new information, it processes the new information, and it dynamically changes its trading approach. Likewise, here also we'll be continuously consuming information. We'll be in the screen time, we'll be continuously monitoring the markets, we'll be continuously looking into new information, so that we'll be developing newer skills as the markets are showing new information, right? So it's not just only we are going to deal with the old strategies. Over a period of time, you'll be able to cultivate newer strategies as you are able to see new data points which you haven't seen in the past, right? So the framework itself adaptive, it helps you to see newer information in a better manner. And I believe this trade zilla 2.0 will be an better I would say that it's more about how to see these markets in a better way with a completely different different angle, right? And anyways, we'll be starting right from the scratch. So all you need to do is the basic technical analysis knowledge or a basic market knowledge is enough to go through this information. And we'll be mostly dealing with Nifty futures, Bank Nifty futures actively. And some of the examples we'll be taking from the US market, the ES mini, like Nifty futures, which is traded in Indian markets. We'll also be dealing with the ES mini, the US market index futures. And we'll also be dealing with a couple of stocks. When it comes to stocks, I'm going to limit to 2 or 4 stocks and that's we are going to deal only during market hours, right? So and we'll be going to have a very focused approach on market profile and order flow, nothing else in this session. Before getting into the session, if you have any questions, I'm happy to answer. You can unmute your mic anytime and you can ask questions. But at the same time, I would also request you not to disturb the flow. Mark your questions, and whenever I'm asking for a question, you can unmute your mic and you can answer back. It'll be more of a two-way communication, so that it'll be interactive. At the same time, I request you not to disturb often, so that it will disturb the flow. And it also disturbs the learning of the other participants as well. It's closely, I guess, total 23 plus participants are supposed to be involved today. I would recommend you to maintain the culture throughout the period. If you have any questions, you can ask me right away. Okay, if you don't have any questions, then probably I can move to the next slide. Okay, so what is market profile? Market profile is nothing but it's basically it's a visualization tool. When it comes to visualization, we'll be looking into what is happening in the markets and what kind of market participants are coming into the market, what they are exactly trying to do, what is their trading behavior which is going on. So it records the market activity. Generally, if you look into the candlesticks or bar charts, it records only the price activity, right? So what the price is doing mostly. But when it comes to market profile, it is a visualization of the price in the form of price distribution. So when we are dealing with price, we have a very limited access to the information. Whereas when we are dealing with price distribution, right, so it brings more meaningful information about what traders behavior is going on in the markets, what kind of emotions which is prevailing in the markets, and there are many subtle nuances. It helps you to explore better trading opportunities. At times it could be low risk trading opportunities. At times it could be signature trades, which comes not very often, but when you're able to see such kind of signature trades, you'll be able to recognize those signature trades. When you're dealing with market profile, you'll be able to recognize price, time, and volume, right? And time is a very crucial factor here, which we eventually miss in when you're dealing with a candlestick charts or when you're dealing with bar charts or some other price-based charts. We miss the critical element time here. So whereas time is a critical element here, price distribution is nothing but it's a combination of price and time, right? So maybe once we look into the basics, we will come to appreciate the time, or you'll be able to appreciate the importance of time, right? It exactly helps intraday traders and short-term traders to effectively understand what market as a crowd is doing, right? Are they doing a good job? Are they doing a bad job? Or probably what kind of confidence which is going on? Is it a good confidence? So once you know, it throws you, market profile, it throws you a lot of information, right? So our job is to record all those information, keep it in your memory, and how to react to those market generated information. We call that as market generated information. Every market activity, as the market started moving up and down and up and down and up and down, the market profile tool records you all those information, and probably your job is to interpret those information and take a note of it and keep following those instructions as per our framework. So for market profile basically follows auction market theory. Auction market theory talks about how the auction is happening in the markets, right? So here is a classical example here, where the floor traders are showing their palms in, and some of them are showing palms out, which means ideally they are using hand signals to buy in or sell their stocks. this is a old tradition which is followed in a non-electronic markets. I mean, in a before electronic markets during 1980s or 1990s, where the CME exchanges and CBOT exchanges in US market, they adopted the hand signals, and the floor traders, they are the one who's physically present on the floor. Some of them could be a dealer, some of them could be a broker, and some of them could be the small trader, big traders like Goldman Sachs, big traders like JP Morgan. Everyone physically present on the floor, literally on the floor. The small trader have access to what the big traders are doing, and the big trader have access to what the small traders are doing. So everyone knows everyone there, and everyone knows what the other party is doing on. Everyone knows what their competition is doing. So even a small trader can know what Goldman Sachs is doing. A big order, buy order is handled by JP Morgan, right? So that's what on the floor it happens. But those days it's more of a sound based edge. When I say sound based edge, it's like there will be a lot of noise generated on the floor when there is a huge activity is happening. That means more people are interested. When the floor is so noisy, that means more activity is happening on the floor. More people are interested in buying or selling. They are interested in doing some activity. They might be doing buying or selling. Let's say, for example, when a previous day high has been broken out. Let's say when a previous day high has been broken out. When a previous day high has been broken out, and if the floor is getting noisy, right? So whom do you precisely think they might be interested? Let's say this is previous day high, previous day high, and I mean that means yesterday high has been broken. Market is just broken yesterday's high, and all of a sudden there is a huge noise which is getting generated on the floor. That means more people are interested, and most likely the traders who are watching those levels are interested in buying at those references. That's why the huge noise on the floor is getting generated, right? Whereas let's say when the price is breaking previous day high, and if there is less noise on the floor is getting generated, what does that exactly means? It means that not many participants are not interested. So that from the sound based edge itself, you will be able to say that not much of people are interested if the low noise is going to get generated on the floor, right? So that means very less and less people are interested about previous day high. Whereas if more noise is getting generated, that means more people are interested on the floor, right? So those days are more of a sound based edge there. And typically once the market becomes completely electronic during 1995, and in Indian, when it comes to Indian markets, it's completely become electronic around 2000, right? Everyone shifted from the flow tradition to completely computer based trading, right? So and then from there it evolves algorithmic trading. So those days it's more of a sound based edge, but these days it's more of a visual based edge, right? When I say visual based edge, those players, when I say players, some of the traders behavior are very visually, we'll be able to spot out those traders behavior, right? I'm going to show you a couple of examples how visually you can identify what kind of traders behavior is going on, right? That's what the whole next 30 days is all about. The next 30 days, next 63 hours of learning is all about trying to understand how the traders behave and how we can able to explain each and every move, who is responsible for this trading activity, right? So when you are able to spot, how we can spot an weaker trading activity so that we can trade against them, how we can spot a stronger activity so that go in line with them, that is what we are going to focus. And yeah, somebody has some question. Okay, so if you're not able to hear the voice, I would say that it's better to close and restart. If you're facing any voice issues, I would say that close and restart, reconnect, right? Yeah. So why precisely I'm using market profile? I'm using market profile to understand what kind of trading emotions is going on, what kind of market confidence is going on. So the market confidence and market emotions, so these are the two factors which is missing in most of the classical technical analysis. If you look into the classical technical analysis studies like RSI, it will not talks about what the market is doing or what the market participants are doing. It will mostly talks about what the price is doing. Let's say RSI, it says like it is at overbought level or oversold level. Right? That's what you'll be able to interpret from the RSI, because it's nothing but a price based information. RSI is nothing but a formula which is developed on top of price-based information. So it is mostly price sensitive. It again, RSI again talks about what the price is doing. RSI or stochastics or MACD. Most of these technical analysis indicators are nothing but the price-based derivative. It is nothing but a mere formula which is derived from open, high, low, close, volume, or in worst case, it will be derived from the open interest. So most of the indicators are nothing but what the price is doing, what the volume is doing, but it doesn't records what the participants are trying to do, right? What the market participants are trying to do, how much emotions they are getting carry forward. Is the market is getting into an extreme emotional sentiment, right? Or as a market as a whole, as a participant as a whole, how they are behaving today? Is the market is showing a sign of good buying confidence or good selling confidence, or a bad buying confidence or a bad selling confidence? It doesn't the indicators doesn't give you clarity on those market in confidence. That is where there is a real edge is there in market profile, and it helps you to market profile helps you to understand weaker auctions. It helps you to understand which are the strong auctions. That means when a strong flow is coming in, strong players are coming into the markets, how you can spot those stronger auctions. And that it helps you to identify where those weaker hands are placing their stops. It helps you to identify the trading inventory. Trading inventory is something like it's something like an overbought or oversold kind of situations when it arises, right? The overbought or oversold will be talking from what kind of participants. Is the intraday is getting overbought? Is the intraday players, all the intraday players in the crowd are getting overbought or oversold? Or all the short-term players in the crowd are getting overbought or oversold? Or the long-term players are getting overbought or oversold? Right? So whereas the indicators will be talking about whether the price is overbought or oversold. Whereas when it comes to trading inventory, it talks about whether the participants or we classify the participants into different types: intraday players, short-term players, intermediate players, long-term players. What kind of players is getting long to too long, or what kind of players is getting overbought, what kind of players is getting oversold, so that you can let's say intraday players are getting overbought. We call that as an intraday players are getting long to too long, right? So in that case, we'll be saying like it is an intraday trading. You have that ability to trade against the intraday players. So when intraday players are getting long to too long or getting overbought, so naturally they tend to do an inventory correction. So that will be useful if you're able to spot such kind of patterns. It helps you to trade you can do a mean reversion trades against those intraday players. Whereas let's say, and that gives you an intraday opportunity. Whereas let's say if the short-term players are getting long to too long, that gives you a positional trading opportunity. Whereas if the long-term players are getting long to too long or short to too short, you'll be able to get a long-term trading opportunity. So depends upon who is getting long to too long, your trading approach changes over here. So it's kindly a dynamic approach. You'll be able to do which is an intraday trading approach, which is an positional trading approach, and which is an investing trading approach. You'll be able to focus on any kind of approaches. That's why I say like it's more of a dynamic approach. And you'll be able to understand who is dominating. When I say who is dominating, it again talks about the traders' behavior, what kind of traders' behavior is currently going on, and who is taking control in the markets, whether this day is completely controlled by intraday traders, or whether this day is completely controlled by positional traders or institutional traders or long-term traders, right? What kind of players are coming into the markets and how they are controlling it, how you can visualize from the profile. Everything is more of a visualization tool here. There is no math involved in market profile or order flow. It's absolutely an art, right? It's completely an art. It's completely a radical thinking. I would say that it's a new way of thinking into the markets to gain a market edge in a very short-term trading activities, right? And precisely we have 10 to 12 approach to spot whether the current swing is secured or not. Which are the ways it is secured, which are the ways it is not secured, and that helps you to give more clarity about the current prevailing trend. And okay, here is the basic market profile tool looks like. It starts with letters, and each and every letters is called TPOs. They are called as an TPOs. Time, price, opportunity. So each and every letter here, each and the letter A, right? So every day the market opens, it starts with the letter O, and depends upon software to software. Whereas I'm talking about Bell TPO NinjaTrader 8 version, where the price open is mentioned as letter O, and whenever the price activity started moving upper and lower, right? It's every half an hour a new letter gets generated. As the price moves up and down, it prints the letter wherever it is traveling to the new information, right? And so 9:15 to 9:45, 9:15 to 9:45 is where the first letter A will start. 9:45 is where letter A will start, and letter B will start from 9:45 to 10:15. Letter C will start from 10:15 to 10:45. So that if you want me to simulate the market activity, I can show you how we can simulate the market activity here. What I'm going to do here is, so here is the market profile charts. Of course, I'm using an ultimate edition of Bell. It's Bell Market Profile Ultimate Edition with automated reference lines. Some of the reference lines I also draw manually over here, right? So what I'm going to do here is that how the market activity, how market profile records the market activity. That's what I'm going to show here. I'm going to simulate the 4th Jan, yesterday's trading information. And I'm going to explain how it happened. So I'm going to close the remaining things except this. Okay, so here is the market activity. What I'm going to do here is that I'm going to disconnect my data feed. Disconnect from the NinjaTrader 8 control center. I'm going to disconnect the data feed. I'm going to connect to the playback connection. Playback connection is a very interesting feature where you will be able to simulate market activity at the market speed or at the improved speed. So I'm going to connect to the playback connections, and I'm going to play the 4th of Jan information. So I'm going to play the 4th of Jan information. So play. And it requires tick level data feed. So I'm using global data feeds here. May take some time to set up. Yeah. So it's here. I think I have to enable tick replay connectivity. Just give me a 2nd. Let me check. So what I'm going to do here is I'm going to stop the playback connection. Disconnect. Make sure that I'm going to connect to the global data feed. First of all, I need to enable what I want to show is the market activity there. Okay, maybe I have some other video samples. Let's not waste time here. So let's quickly get into have some. Okay, let's take this video example. Okay, so here is the example. So as the market opens, so here is what the market opens over here. The market opens here, which is usually shown as the letter O, or if you go, you can compress or expand. If you compress, it will become blocks. If you expand, it becomes letters, right? So every day it develops a distribution. So as the price keeps moving up and down, it records the activity. And here currently the letter A is running on. Here the letter A is running on. So wherever it moves, the price is ticking up and down. It's going down and it prints the new letters. So I am expanding the charts over here. So you can see the letter. So the price opens around 10,750. So it is activity which got recorded on 4th of October. And the hash here, which shows where the current price is getting traded over here. Right, so the price is moving up and down, up and down. So I'm running the market at 20x speed. I'm running the market at 20x speed. So that means each and every tick is, it means 20 seconds of market activity. It's really running at a faster speed. So NinjaTrader precisely gives you controls to add text. You can draw lines on top of it. What I'm showing you here is that it's on that day, it's a gap down. When I say gap down, I'm meaning here is that the market opened down below previous day high. Market opened down below previous day high. And we'll say like whenever there is a gap up or gap down is there, we'll say it's a high confidence markets. They are, so we'll say like the high confidence is prevailing at the market open. And then we'll start recording many informations. Right? Probably you'll be writing all this information on your trading sheet. And you can see here, I'm going to pass the video here. What I want to show here is that when the time becomes 9:45, automatically the letter B starts. The letter B starts. You don't need to know where it's opening, where it is closing. We're not interested in where the candle opened, where the letter opened, where the letter closed. All you need to know is that how the trading activity is happening, right? So as the B letter starts, as I said, B letter starts from 9:45 to when 10:15. 10:15, the letter B starts. The letter B starts, and you'll be noticing two kind of trading activity. You can see that this is normal profile. This is normal profile, and this is a split profile. So normal profile we'll be using to understand how the price distribution happens, and split profile will be using for intraday purpose to understand. It's as good as using your 30-minute candlestick charts. It's as good as using your 30-minute candlestick charts. So let's say now I'm running at 100x speed here. Now let's continue the trading activity. So at this point of time, now letter C starts. So letter C starts from 10:15 to 10:30. Right now, what you can see, what you can give weightage to this information here is that to recognize the time, right? So you can see the letter ABC. You see the letter ABC is getting formed. That means I said what each and every letter is a TPO. Letter B, letter A, letter B, letter C. Ideally, it doesn't matter. These letters doesn't has any meaning to it. You can use letters, you can use blocks or any kind of representation. What I am very much concerned here is the time where price is spending most of the time here. If you see here at this point, the ABC formation over here, it's getting widened here, right? So that's a distribution I'm talking about here. Here, more trading activity is happening on that day. More trading activity means more letters are getting traded over here. Every half an hour, once 10,730 is getting traded at this around 10,730. That is very important because market is establishing a balance over here, right? So market is building an equilibrium point. That could be the equilibrium point for the day because the day is getting widened. Let's continue the auction here again. So it's moving up and down, up and down. So 10:15 to 10:45 is what letter C is all about. From 10:45 onwards, you can watch the time here. You can watch the time here. So letter D is about to start. So letter D arrives now. Now I'm going to pass the video again. So I'm going to pass the video again. Now, if you see precisely again, the equilibrium point shifted over here. See that more activity is happening over here, right? So more activity was happening over here. See that ABCD. That means 4 TPOs. Total 4 TPOs got traded over here. Each and every letter is a TPO. So now I am seeing 4 TPOs over here. More than 4 activities happening over here. So that is the point of control is getting established. That's your equilibrium point. That point will be shown as a black colored dot. The black colored dot is called as your point of control, POC. So I'm sorry, POC, point of control. So as a trader, where the point of control is getting established is very much crucial for you. It is where the point of control is trading right now, where the point of control is developing. Is the point of control developing above the previous day high? Is the kind of point of control developing below previous day low? Is what the primary thing which will be start observing those markets right from the day start, where the point of control is getting developed. We will be keep on taking a note of it. So where the point of control at 9 o'clock, where the point of control at 10 o'clock, where the point of control at 11 o'clock, 12 o'clock. So we'll be keep on recording at frequent. We'll be keep recording at maybe to summarize what I'm going to show here is I'm going to put in a notepad. Do I have a notepad here? I don't have, so I'm going to bring one. Notepad. So first thing to what to observe from market profile, right? So we'll not be observing what to buy, what to sell. To get the context, we'll be observing where point of control is developing for the day, right? So in other words, in our terminology, we'll say like where market activity is getting widened horizontally, or we can also say like where most of the TPOs are getting traded. So that's what we'll be observing from the market profile. The second thing what we'll be observing here is that we'll be observing both normal profile for profile distribution. We call that as a distribution, and a split profile from an intraday perspective. So split profile will be watching from an intraday perspective. So if you're not an intraday player, you don't need to give all your ears to split profile. But still, if you want to know how the trading activity happened, only if you want to look from a price base how the activity is behaving, you can go and listen to the split profile, right? So now let me continue the video again here. Oh, okay. I'm sorry. So we are somewhere over here, right? So Yeah, so the ABCD, as of now, what we've seen is an ABCD activity. And so these are the observations I'm making over here. What are the observations I'm making here? I'm just keep a note of it. Either you can keep a note of it or you can follow the traders worksheet, which I'm going to give. So one more thing, one more activity is getting developed over here. It's called as one-time framing. I'm going to pass the video again to explain what is one-time framing. Anyways, we'll be talking all those terms. I'll be explaining all those terms. So what is happening here is that the market is one-time framing, means the market is making lower highs continuously. You see that highs of letter A, the high of the letter B, high of letter C, high of letter D, and high of letter E. It's continuously going down without breaking the previous bar high. So you can ask me one question: what is the size of letter A? So when it comes to Nifty futures or Bank Nifty futures, I'll be using 1 point. Each and every 1 point, a new letter will get generated, and that will be controlled by the software. You have the complete control to change different points, different brick size for the we call that as a TPO size or price per row. So you'll be able to control from your software. 1 point is the recommended size for trading with Nifty and the Bank Nifty. Whereas different market profile traders uses different approach. I precisely follow Jim Dalton's principles. So I use lower TPO sizes. So when it comes to Nifty or Bank Nifty, 1 point TPO size is the appropriate TPO size, I would say that. And which is what we are using for many months and years to go, right? So now the letter E got generated. You can see that the E is getting elongated on the downside. The E is getting elongated on the downside. What is getting forming is the profile distribution is getting formed over here. The profile distribution is precisely getting formed over here as the time grows by, and this time the point of control is still staying at the same place. You see that 10720, the equilibrium point is still staying over there, and the market activity is getting generated over here. So now I'll continue the video here again. One thing you can note, you can see that the letter B high is exactly at the day's open. The letter B high is exactly at the day's open. So we are seeing one time framing is happening over here. So when one time framing indicates a good confidence, one time framing indicates good confidence. So market itself initially opened gap down. So don't fade the markets. Again, one time framing is happening. One time framing again is also again a sign of a market confidence. We'll be talking market confidence in detail, but now we can see that for the very first time, the letter F has been broken. The F high has been broken by letter G. So we say like the one time framing came to an end. And okay, I'm going to show here something interesting is happening over here. What happened here is, see that initially it was A, B, C, D is the letter where the 4 TPOs got traded. These are 4 TPOs got traded. 4 TPOs. Right. So now the activity is moving a little bit. So you see that it is 5 activity over here. It's 4 activity over here and 5 TPOs over here. Means more than 5 times that particular price has been revisited. The price has been that particular price. What is that price? Almost 10710 got traded 5 times, whereas somewhere around 10725 got traded only 4 times. So that is why wherever the maximum activity is happening, the point of control shifts over here. There was a minor shift. There is a minor shift happens over here. Right, so that is a good selling. That's still a good selling, I would say that. So means the confidence is good. The point of control is shifting down. In a good market, the point of control shifts down in a good selling market. In a good uptrending market, the intraday point of control shifts on the higher side. So that let's say Monday market is going to open higher. Monday, like so, SGX Nifty is currently positive, right? We closed around 10,780 last Saturday. 780. If it is a good market, what happened? Let's say Monday market opens. we immediately try to find some sellers. No sellers are there. Market auctions higher, and a good activity, good market activity. It first builds an equilibrium point. It shifts and it builds more equilibrium. The equilibrium point shifts on the higher side, right? That is a good buying activity, right? And so if the point of control is shifting higher, that means more players are interested on the higher prices. That's what it means, right? So in this case, the more players are interested on trading on the downside. That's what the equilibrium point talks about. The equilibrium point is shifting lower. Okay, I'm going to continue the video here again. I'm making again observation. Generally, I don't make observation just like this on the screen, just to show you how the point of control is shifting down. That is one more observation I'm making there. As the time grows by, in a day, you'll be getting 13 letters. Total, you'll be getting 13 letters in a day. Total 13 TPOs, right? So total 13 letters in a day you'll get, right? Starting from A to letter M. Letter M if you are trading in a NSE futures markets. So point of control, we call that as a point of control, or I'll say like POC. Okay, the letter I started. Again, J is going to start. The J also started. You see that activity is building lower, which is very good. And the confidence is also remaining high. So in that, when the confidence of the market is really high, we don't trade against the markets, right? So that's a 5 TPO. I'm going to pass the video here because something interesting again happened over here, which doesn't happen more frequently in the markets. See that the point of control shifted over here. The point of control shifted over here. It shifted over here because now 6 TPOs got traded over here, 6 TPOs over here, 6 or 7 TPOs over here. So throughout the day, the point of control is shifting down. The point of control is again shifted down. Point of control again shifted down. That is again my reading there. See that the black dot also migrated down. Right, so you will be able to recognize the time. Time-wise, the price is shifting down. Initially, more activity happened over here. I mean, later on, more activity happens over here. 5 TPOs got generated over here. Now, more crowded activity is happening over here. So you'll be able to give more importance to where the more activity happening at that place. So that you can say that the 7 TPOs got traded over here. My recording is like 7 TPOs are getting traded over here. And the activity is continuously shifting down for the day. So these are the basics which will going to help you to see the market and to evaluate your trading decisions with better odds. I would say that, right? And this is how the market reading it's supposed to be when you are dealing with market profile. And we'll be digging deeper into this. This is right now what we're dealing with, the very core basics of market profile reading. And soon we'll be learning new terminologies, patterns associated with it, and the rules, the rule book, what the rule book says, whether it's a long or whether you have to look for a mean reversion opportunity where the stop loss is getting built. Many things we are going to talk about over here. Okay, so that particular day, the letter M is what the last 15 minutes. All the letters go for half an hour. Only the last letter M will be running only for 15 minutes. So this last letter runs for 15 minutes. 15 minutes. The last letter M, which runs for 15 minutes, because markets are in such a way, like the markets. The markets 9:15 to 9:45, 9:45 to 10:30, and so on. Last will be from 3:15 to 3:30. Right? So because of that last 15 minutes activity, it's fine. It's fine that last 15 minutes we are getting only one letter over there. It's fine. Nothing to worry about it. Right? We are not looking into that kind of precision. Like we don't have any rules like each and every bar should have 30 minutes. Right? As the day ends, this is how the day ends. The day ends with the hash over here. The hash tracks the last traded price, and so it will be looking like a hash symbol over here, red color hash symbol, right? So overall, you'll be able to narrate from the trend. So this is like in the split profile. So from the split profile, what you can see is it's like a candlestick charts. It's like a candlestick chart. It tracks the price activity, right? Whereas the profile distribution says where the activity is maximum and how emotional the day is, or how the structure is getting built, right? So we'll be talking more about profile structures in the later session. But as of now, you keep remember that most of the days you're going to get a bell curve shape profile structure. You're going to get a bell curve shape profile structure, and as the market is doing a lot of activities, it gives you a lot of information. One of the information it is getting here is that the more activity is shifted down, that means more players are interested on the downside, and a good selling is happening, because if it's a good institutional selling, a good institutional selling will be like this. They push the price down, more activity happens. This is where the liquidity happens in the markets. Again, push down, again a wavy type liquidity happens in the markets. Again, push down, again a good liquidity, a good activity happens over there. So they are coming and selling in tranches. Mostly it could be an institutional activity. Again, drop, it's going down. Again, drop, it's something, again drop. Right? Something like that. It's kind of a wavy selling. It's where the institutional activity happens. So again, it helps you to understand many subtle information which will be missing from the candlestick charts or from the bar charts or the tools like Bollinger Band or moving average crossovers, right? Okay, I'm going to take some questions over here, and once we are done with the questions, we are going to take an 10-minute break. If you have any questions, you can unmute your mic and you can speak back. I'm happy to answer all your questions.
Hello.
Yeah.
Rajendra, Vivid here.
Yeah. Tell me.
Thanks so much for a great start to the presentation.
Okay.
So question is, so this is all about price. So is there anything related to volume also in market profile, or
exactly here? So the left hand side, what you're watching is this is nothing but the price based distribution. How the price is getting distributed at each and every price level. You see that this price only one time it got traded over here, whereas here this particular price 2 times the letter got traded over here. Whereas as the day develops, 3 letters over here and 4 letters over here. This is it's talking only about the price perspective. That's what market profile does. Whereas the next to that, what you're seeing is the volume profile. It's nothing but the volume profile. Profile. It again talks about where the maximum trading activity is happening. When volume is nothing but what? So at this price, volume is maximum. So you can see that this band, the volume is maximum over here. That means more participation happened over here. Most of the times where the point of control is there, price-wise point of control and volume-wise point of control will be more or less same. At times it could differ. Maybe the price went fast on the upper side where one guy would have come and punched a bigger order over there. So those kinds of levels we call as an high volume nodes or low volume nodes. High volume nodes are like where more trading activity happens, and low volume nodes, you see that low volume nodes over here where low trading activity happens, means price spent less time there, so trading volume also was generally lower at this point. So these are low liquidity areas. Most of the time what a market does is that market goes to those low liquidity areas and does some more activity. That's what the volume analysis does. But those things will be dealing even more at a micro level using order flow tools. So order flow tools are nothing but a visualization of the volume profile, right? So we'll be dealing those things, all those volume related things in the order flow stuff. And we'll be focusing on price distribution and price behavior and traders behavior based upon the price distribution. That is what we are going to evaluate in market profile. And when we are going to deal with order flow, it's nothing but a visualization. Again, order flow is a visualization tool where we are going to talk about the volume distribution, how the volume is getting distributed, how the buyers and sellers are getting distributed at each and every price. That is again a microscopic look into the market profile. I would say that is again a microscopic look into market profile or microscopic look into the candlestick studies. which will give you even more better odds when you are trading at a very, very lower time frame. To do a scalping or to do some intraday trades, Autoflow is one of the best tool, I would say that.
Thanks so much.
Yeah, thank you. Any other questions?
ಹಲೋ ರಾಜೇಂದ್ರ
Yeah.
ಪ್ಲೇಬ್ಯಾಕ್ ಮಾಡೋದಕ್ಕೆ ಹೇಗೆ ಅದನ್ನು ಯೂಸ್ ಮಾಡಬಹುದು?
Can you speak a bit louder? I'm not able to get your question right.
Playback, how to use playback facility?
The playback facility is...
I have tried in Baltic, but I am unable to.
Yeah, maybe I can show you now how to do a playback, because some of the settings you need to be aware about when you are playing with a playback. Playback requires tick level database.
Yeah.
Right? So because it needs bid and ask data, it needs tick level information to replicate the exact market activity. So playback requires tick data feed. Right? So if you are using global data feeds are true data. They provide tick level data feeds, and they generally provide only up to the last 2 days, only 2 to 3 days of tick activity, right? So means as you have more data points, as all the tick level the information gets stored, only those data points will be able to simulate. So if you are and was couple of information you need to set, you have to go to tools, you have to go to options, and go to the market data. From there you have to enable couple of things. Show tick replay, this has to be enabled, and also it also a good practice to enable market recording, but this will add more to your memory. So these 2 settings are mandatory over here. So these 2 settings you add to this: show tick replay and enable market recording. Once you're done with that, you go to your charts. So as of now, what I'm going to do here is I'm going to disconnect from the, okay, I think I connected to the global data feeds. Get some historical replay. So right click, go to the data series, and here you need to enable tick replay over here. So I am repeating again: right click over the charts, go to data series, and there you have to enable tick replay. The tick replay here has to be enabled. So, and apply it, press OK. So now you see that it says like it start loading tick replay. Let it reload. So once it's got reloaded, you will be able to simulate the market activity. Generally, if you are dealing with US markets, generally the tick replay will be automatically enabled. You don't need to if you are using ES Mini, you can straight away start using tick replay. So there is a question from Rohit. His question is whether a market profile can be used for swing trading. You can do swing trading. You can also do mean reversion trading. It's a dynamic approach. So based upon what kind of activity is happening, based on that you'll be able to do swing trading. You can able to do both trend following and a mean reversion activity. You'll be able to do that.
Rajendran, hi, this is Ramesh.
Yeah, tell me, Ramesh. Good to see you back.
Oh, thank you, sir. Thank you. So one question, Rajendran, in the market action that we saw,
yeah,
and high confidence, opening that we talked about, right? And then for the price control shifting lower.
Yes.
And the lower, portion of the profile where we saw a lot of market activity. Now, would it have been possible to foresee this high confidence opening at the prior, day's action? would it have been probably probability of this kind of, or any clues that we would get in the prior day's action that would lead to this kind of high confidence opening that we saw
Yes.
on 4th of Jan?
I would say that not every time we are gonna, time to time we are not gonna get those information, but based upon what the information is presented, probably you'll be able to estimate that could be a possible gap up is gonna come, or that could lead to a high confidence. So if the market is gonna have open high confidence, how you have to position yourself in the markets?
Yeah, exactly.
Evaluate. And whether tomorrow it's going to be a high confidence open or not, I don't know unless the market opens.
Okay.
So, but there are days, yes, we will be able to forecast those high confidence movements, or we'll be able to forecast that tomorrow is going to be a dull, boring day. There are certain days we'll be able to say, like, this day is going to be a balanced auction. Once the market started doing some, within 10 to 15 minutes or half an hour, you'll be able to say that this day could possibly end up in a sideways action, or maybe last 1 hour we may see some activity. But in the meantime, we may see some sideways trading action. That kind of forecasting ability will be able to achieve. That's for sure. And there are days, yes, you can able to predict the market activity, but confidence is what you cannot time to time predict the confidence, but you will be able to appreciate that if there is a change in market confidence, all of a sudden if there is a good buying confidence is going to bad buying confidence, probably you have to recognize those nuances, right? So all these nuances will be recognized using the tools like point of control or value area. The other references will be able to spot if there is a change in the confidence in the market or not. So based on that, we can position ourselves accordingly in the markets.
Okay. So in this case of fourth activity which we saw,
yeah.
Do we see, how do we position ourselves from a day as activity, right from starting from the opening that we had?
Maybe I'll try to show you anyways, we have a separate session tomorrow to explain the market confidence.
Okay.
But for time being, I'll show how how a good activity develops. If it is a good activity, right? If it is a good activity, maybe let me try playback of yesterday's activity. I'll disconnect the feed. I'll connect to playback connection. I'm not very sure whether I have recorded yesterday's activity or not, but let me give a try.
So do we have to record first and only then we'll be able to play, is it?
No, you'll be able to play, but I don't know why it's not happening, or let me check. Or maybe some other day's activity would have been recorded.
Because most of the times where I keep losing out is positioning, myself to the opportunity that is unfolding.
I understand, but that is where we built an market confidence so that we can take an objective decisions.
Okay.
And that is where precisely we'll be able to change our mindset faster. It is an indication that you have to change your mindset first, because something is changing in the markets. The change in confidence is nothing but something different has changed in the markets. Now you have to see the market with a different view, with a different angle. That's what it means.
One is understanding this shifts and the change in confidence, and second thing is that how long is this confidence is going to sustain for the next 1 day, 2 days, 3 days, so that you can take advantage of that confidence.
Yes. I'm sorry, I think it's moving, so I have to. So this is last Friday's activity. Not last Friday's activity, but last
Friday's activity.
Thursday's activity. Just give me a second. I'm going to pass it for a minute. Yeah, it loaded. So it almost you see that the price opened. So if I compress, I can compress the charts. I can expand the charts. I can do both horizontally as well as vertically. So I can see more. If I want to see more profiles, I'll go to my lower letters, and I'll be pinching and moving up and down. So it compresses and it expands, right? So one setup you need to aware about is you should use only on a 30-minute time frame, right? So market profile is completely independent of a time. Every day you will be getting only one distribution, and that is still customizable. If you want 2 profiles in a day, let's say first 4 hour one distribution and remaining time you want another distribution, you can create it. There are a couple of controls. Probably I'll show you time to time. I'll show you how to use those controls. But standard thing, what I'll be using is the standard settings. I'll be getting only one distribution every day, and let's say yesterday's activity. So here is what the yesterday's activity. If you look into yesterday's activity, more activity happened over here, followed by a single print. We call that as a single print because only one letter got traded in the middle. And again, one more distribution happens. So it's 2 distribution happened over here. We call that as a double distribution. And so likewise, you'll be able to visualize how the activity happens. Every day, not every day you're going to get the same classical profile distribution, right? So someday like here, you're getting more activity here. Lately, you're getting a spike. And here, the price opens here, it went down and more activity happening over here. The other day, price opens here, it spiked up and more activity happened at the top. So likewise, but each and every distribution, how the distribution is happening, it explains a set of specific traders' behavior, and it explains how you have to position next day and how you'll be able to evaluate the market confidence time to time. And all these reference level, all these automated reference level, it used to come only on the Bell Market Profile Ultimate version. Probably if you are running a basic version, you may not find those automated reference line. Anyways, I'll be showing you how to mark those reference lines. Even if you don't have this Market Profile Ultimate Edition, you'll be able how to plot those reference lines and what are those importance of those reference line. We'll be talking during the course, right? And okay, let me start the activity here. Okay, I'm going to increase to some 10x speed. So 10 times of market activity. Now letter C is running on. You see that the point of control is getting established over here. This is where it's getting established. So ABC, the point of control is over here. Maybe I'll increase the speed a bit. $30x. So it doesn't matter whether I'm using a letter or not. So that is why it's color coded. So you know that it's a red color means it's letter C is running on. So you don't need to bother about whether it is letters or bricks. I am very much comfortable with both. So you see here again, the activity is shifting over here. You see that initially 3-letter activity is over here, and now almost 3 activity is shifting down here. Means even if the price comes up in the next subsequent letters, you'll be getting 4 TPOs over here. That means point of control can shift down. Point of control can shift down over here. Right? Still, it's an inside bar. Still, throughout the day, it's an inside bar. It's an inside bar compared to the previous day's range. It is an inside. It's a complete inside bar so far. So when it's an inside bar, we call that as an low confidence activity. If it has to become an as long as the price is trading inside the previous day's range, we say like neither the buyers are confident nor the sellers are confident. If there should be a change in the confidence. What has to happen is that market has to show somewhere some sort of confidence, like in the form of one-time framing or somewhere, or it breaks the previous day low. Right? Still, you see that letter. These letters are now one-time framing here. One-time framing 1 and 2 and 3. It's continuously moving down without breaking previous day's previous bar high. Of course, they are 30-minute bars. So you'll be able to visualize those in one-time framing from a split profile. Whereas from the normal profile, it's tough to visualize whether the one-time framing is getting developed or not. Whereas from a split profile, you'll be able to learn those things. Okay, those orange, the yellow color bars are nothing but letter E. So the E is going down and down. price is pretty close to previous day's low. See that the previous day low is over here. So maybe you can mark a line and you can still say like, you can take a tool and say like previous day low if you want to watch. Again, you see that letter C, D, E and F are continuously one time framing. So day low. So this is what I'm talking about here. I'm going to pass here. You see that something interesting is happening. Letter J, you notice the letter J and letter F. What is happening over here? The letter F is just only 1 point. Each and every block is, as I said, it's one TPO. It's 1 point. So the letter F just went only one tick and it went above. This is exactly the traders' behavior of intraday players. You know that an investor will not come and buy just like that. They will not be waiting for the previous day's low to come, and they will not take trading decisions over here. So who were coming precisely at the previous day low, they are mostly trading money. Trading money, when I say trading money, it can be intraday players or it can be some traders who are coming and buying exactly at the previous day low, or exactly 1 point above the previous day low, exactly 1 point below the previous day low. Someone, they are behaving very mechanically here. So we call them as an mechanical traders, or we call them as an weaker hands. They are weaker hands, and we call this low as a weak low. We call it's nothing but the previous day low, but now we call this as a weaker low. We call this as a weaker low, which has a higher odds of price coming and taking it out. Which has a higher odds of price coming and taking it out. So maybe I'll run the simulation again here. You can see again, those are short-term nuances where that day low is not a secure low. From the intraday standpoint, it will be broken out again. I don't know, but when, but that particular day, it has that low is not a secure low. That's the only information you can grab from it. Right? Still, your reading is that now C, D, E, F is one time framing, means it's a high confidence market. You're dealing with a high confidence market. In a high confidence markets, better don't trade against those high confidence markets. Just go with the flow. As long as, because previously what you're seeing is a low confidence market, price was trading inside the range. Still price is inside the range, but still now look into that, the one time frame is getting developed. Again, letter G, again, I'm going to pass here. You see that something interesting is happening over here. The letter G also precisely coming and bouncing exactly from there. Like maybe we may not give, when you are watching in candlestick charts or in bar charts or some other variations or like a point and figure, you may not give importance to these kinds of visual information, right? But when you're seeing this visual information again and again, time to time, it says that we are dealing with intraday buyers here, and they're mostly weaker hands, and the level is getting more and more weaker here. The more the level, let's say again and again, it's getting punched again and it's getting punched every time it bounces back from the levels. More it's gonna bounce from here. Higher the odds that it's gonna come and test faster. So I'm gonna continue the activity here again. So letter G. So maybe I'll move the charts a little bit. So means most of the intraday players would have a stop below this level. So when the price is breaking, at times it breaks really fast. You see that the break, it means maybe some of the stop hunting is going on over there. So they would have been stopped out if they are a scalper, or if they are an mostly scalpers enter over there at the day's low. Mostly scalpers, intraday players enter at exactly at previous day low. Scalpers enter, so they will be having a stops. So that stop would have been taken out all in a sudden. That's what that quick jerk of activity comes over there. And precisely, you need to have an eye about where the point of control is getting. Is that going to shift? It has all the odds of shifting down. Still, it is not shifting down, but all the odds of shifting down, because now it's shifted down. You see that it shifted down because 4 activity came down. Initially, point of control was here. I'm sorry, it was here, and as the time, this is where now elongation is happening. Point of control shifted down. Initially, what was there? Initially my confidence was low, but now the confidence is higher because the price is one time framing. At the same time, it also broken the previous day low also. It also broken the previous day low also. So let me observe some more time. see that price broken previous day low. I think later on it also broken multi-day low also, I guess. Okay. So when the activity is, when the point of control is shifting lower, one time framing, don't ever fade the markets. It's very dangerous to position on the long side. Maybe I'll speed up the auction further. 100x. So the point of control, you see that it's almost 5 activity over here. We have another 3 or 4 letters. So point of control shifting higher, odds are getting reduced as more and more activity is happening around 10,780 levels. 10,780 levels. More activity is happening. Higher the odds that point of control can migrate further. I think this is around 145. Price again shifting lower. It shifts down. And you see where the distribution is happening. Most of the distribution later part is happening over here. And almost 1, 2, 3, 4, 5 TPOs got traded over here. So the day is ending up with a high confidence selling. The day ends up with a high confidence selling.
But Rajan, if you look at the opening, right, it started with an inside day.
Yeah, it started with an inside day, precisely.
Right, and which is a low confidence opening.
Yeah, low confidence opening. But then what is happening here is the later part, the one time framing developed. So that itself is a sign that there is a change in confidence from low confidence. At the opening, neither the buyers and sellers are not confident. But the later part, the one time framing is getting developed. That shows that it's a high confidence market. That's one of the early signs of one time. I mean, market is showing higher confidence.
So if I were to position myself for this opportunity, so at which point or what are the things that we should look at for us to position and then take advantage of this information that is
that is where order flow comes in.
Okay.
So that's why we'll be able to spot the order flow. If you spot the order flow, selling volume was really big on that day. It's mostly institutional volume right from the start. We are able to see an institutional volume.
Okay. So that's looking for a confirmation.
That's looking for a confirmation that which side how you have to position as an intraday player. Right. So, anyways, I'm going to stop here right now. So I guess you now probably would have a fair understanding how the profile distribution develops and how you can split the profile. Probably you can go and split any profile. Right click over the charts and go to the split profile, and you can split any particular day's profile activity. You can right click and unsplit as well. Right, so let's say I want to split this activity and I want to show how the activity happened on that particular day. I'll be able to split and check back. So here is the split profile activity on 2nd of Jan. I'll be able to split and I can even restore it back. Okay, I can also split. I can also merge 2 profiles into one. I can right click and say like merge session right, so that the 2nd of Jan and 3rd of Jan will get merged. Why it's not happening? Maybe in a playback mode it's not happening, but in live session I'll show you. I can split and merge the profiles. Okay, never mind. I can right click and merge split. Yeah, like this you can split. You can multiple days, you can merge multiple sessions into one, so that you can see how the distribution for that week it happened, or last 2 days how the if you merge last 2 days of profile, how the activity happened. You can check in those terms as well, but primarily I don't use all these information. I'll be either splitting or merging those information. I'll be watching both split profile and I'll be watching both split profile and the regular profile here during market hours. Right? And I'll be watching not only how the price is getting developed related to yesterday's activity, or related to 2 days activity or last 3 days activity, how the price is behaving, related to the recent swing high or a recent swing low, or a recent yesterday's high or yesterday's low, or a previous week high or a previous week low. Related to that, how the price is behaving is what we look into, right? Yeah. So let's take a quick break and let's assemble back by 11:35. So time is 11:25 now. 11:35 we'll assemble back, and we'll talk more about the basic nuances of market profile. And then in the afternoon session, we'll be talking about some of the reference line, how to draw all these reference line. The reference line will be whatever I drawn over here, how to draw all those reference line, and some of the signature trades, we are going to talk about it in the afternoon session, right? Thank you. Okay, so let's quickly stop the playback and let's get back to some of the basics here. Right, the charts, what you're seeing here is the market profile distribution, which is the normal profile, and the split profile is as nothing but an equivalent of your candlestick charts. And the volume distribution is nothing but how the volume is getting distributed at each and every price level. The blocks here represents your each and every TPO size, how the volume is getting behaved. So you'll be most of the times where the price point of control is there, volume point of control will also be mostly nearly. Volume point of control is nothing but where most of the volume activity happened for that particular day. Right, again, so next comes the, this is a representation how the volume activity which gets developed over a period of time. Just give me a second, I'm going to stop the playback connection. It's getting interfering with the disconnect. Yeah. So here is a simple representation. Again, we already, since we looked into the video, I'm just narrating once again. Letter A starts 9:15 to 9:45. You'll be getting only letter A, and letter B starts coming in on top of the distribution. It will be aligned to towards the left. Letter B is from 9:45 to 10:15. Again, letter C, you'll be start seeing by that time when the letter C starts, you'll be able to see whether where the equilibrium point is getting established. Mostly in a boring markets, the letter A, B, C, D, E, it keeps widening something like this. As the time grows, you'll be seeing the widening happening. Initially, it'll be A, B, C, and then A, B, C, D, and then A, B, C, D, E getting built in. So these are the classical signs that you're dealing with a sideways market. When you're seeing that A, B, C, D, and A, B, C, D, E, A, B, C, D, E, F, A, B, C, D, F, G. So these are the signs that we are dealing with a sideways market. Right? Initially, it starts with mostly with the A, B, C, D. It starts with mostly with A, B, C, D, and then it as that is an that itself a sign that this day could develop into a sideways day, mostly with the sideways odds. So those are the days where you'll be having only intraday trading opportunity, and you have to wait. Those are the times where you have to wait for your trading opportunity to arise. So those are the times. It's not an immediate trading opportunity if you're looking for some intraday opportunities. And recognizing this ABCD, we call this as an ABCD balancing. Initially we say like it's an market is doing ABC balancing. That means the ABC letters are getting widened. Or we say like ABCD balancing or ABCDE balancing. That means market is doing some balancing activity. When I say balancing activity, it was doing some market activity in this mode, like price is moving up and down, the auction is happening up and down, and mostly the activity is getting balanced at the center. Right? And that when I say balancing, more activity is happening at the center. Okay, at the end of the day, you'll be getting an full-fledged distribution. As the time grows, you'll be able to see that distribution, how the distribution is getting developed for the day. And it varies day to day. And tomorrow we'll be having an exclusive webinar on profile distribution type. What are the different types the profile distribution can be? That's where we're going to deal on tomorrow's session. So here is the comparison between how a classical 30-minute candlestick charts will look like in comparison to market profile. It's 1 day of trading activity. This is April futures over here. So each and every candles are nothing but 30 minutes activity. Where in candles we give importance to open and close, whereas here we bothered only about the highs and lows, and how based upon that how the activity is getting developed and where the activity is getting developed. That's what we bother about it. And let's look into the since every day market develops a distribution, we can compare the market profile distribution with the classical normal distribution, which you would have studied during your high school studies, right? In a normal distribution, we'll be having a mean at the center. So this zone is where the 68% of the trading activity happens. 68.2%, which signifies the 1 standard deviation zones, that is between -1 standard deviation and +1 standard deviation. When it comes to market profile, the same terminology is used, which is, you can see a bracket over here, red color bracket. These red color bracket talks about where 1 standard deviation activity happens in the markets, which we also call that as a value area, or we can say like VA or value area. Right? Every day, as a point of control also keeps moving up and down. The value area also develops. So that's why we call that as a developing point of control and developing value area. So for the day, we call that as a developing value area, or DVA, developing value area, right? Whereas yesterday's value area, we call that as when I say yesterday's value area, it's yesterday's value area, right? And today's value area, we always call as an developing value area. Again, it shifts up and down, but mostly around 1 o'clock or 2 o'clock, the value area will be completely formed. It doesn't shift much after once the value area gets completely established. It rarely shifts in the later second half of the session. And by default, your trading software, most of the trading software uses 70% as the rather than using 68.2. Most of the tool uses 70% as the measuring point of the value area. So that says like where the 70% of the TPOs got traded. Let's say this is 100% of the TPOs. Let's say there are 100 TPOs got traded over there. And relative to point of control, where the 70% of the trading activity happens. So the value area is measured relative to the point of control, right? So let's not get more deeper into it, but as simple as that, where the bracket is there, that is where the 70% of the trading activity happens. Remaining activity happens at the edges. Remaining trading activity happens at the edges. So the 70% of the trading activity involves where most of the crowded trading activity is happening for any kind of trading day. And some of the very basic market profile terminologies, we call that as an initial balance, which is nothing but a first 1 hour range. And second comes the point of control. Point of control, we call that as a POC. POC, when I say the point of control is getting established, or POC is balancing, or price is balancing around the POC, means price is moving away from the POC, it comes down. Often point of control acts like a magnet. Let's say if ABCD balancing is happening, A, B, C, and let's say D and E, it means some activity has been happened, some activity was happening, and then it creates an ABCD balancing. All in a sudden, price is shifting away from the ABCD. It often, what generally happens is that most of the cases, the point of control acts like a magnet, and price often swings between those magnets most of the time. So if you see ABCD balancing, then it has the odds of market doing a balancing activity. So when the price is deviating away from it, either on the upside or downside, price always mean revert back towards the point of control. So there are many strategies which are designed where point of control from an intraday perspective, we treat that as a primary targets, which we'll be talking in the, which we'll be taking it in the later part of the sessions, which in which scenarios you have to use point of control as a primary, one of the targets for your trading studies. So we'll be having in control over there. And value area is again one more observation we'll be keep using into it. We'll be understanding where the value area is getting developed relative to the yesterday's value area, right? So how the value area is getting developed. Is it developing higher or lower? Is it overlapping related to the previous day's value area? So if I look into the current Nifty charts, so one of the observation I'll be making here is that you can see here, this is 31st December activity, value area was here, which is overlapping to the previous day's value area, right? So 31st December activity, the value area is overlapping to the previous day's value area. And you see that 1st January, price was higher. You see that price was higher, but what was happening? Value area is shifting down. Means more, that particular day, more people are interested in trading down. Though price was trading higher, the price was closing positive on that day. It was some 40 points, I guess. 40 points or 30 points, it traded higher. Price was positive, but where most of the activity was happening here, more activity was happening on the downside. That is why the value area shifted down, which is one way of caution in the markets. Like more probably in a stealth mode, in a stealth mode, most of the traders would have been entered over here, right? Whereas lately, some weaker hands would have get caught. The very next day, if these late, I would say that it's late buyers, because you split and know the profile, you know that initially price was trading here, it went down, more activity happened, and lately price spiked in the last couple of trading hours. Maybe I can compress. Yeah, I can show you the entire activity. Lately, the price is spiking up, but you see that the value area is still not moving away. Point of control is not moving away. Point of control haven't shifted. Only price is migrating higher. Point of control is not migrating. Value area still remains the same. Related to previous day is here, whereas today's value area is lower. That is one form of caution sign. Maybe if they are good sellers, I mean, if they are good buyers, let's say these buyers driven the activity here. They're good buyers, right? So next day they would have opened gap up, or next day they would have opened here and they would have taken the previous day high, or even the 2-day high, which is coming very close, and they will build activity higher. Your point of control will start building higher. That is a sign of a good confidence in the markets. But next day, what happened? That follow through, the buyers who showed in the late evening or the late afternoon, they're not serious, right? If they are serious buyers, next day we would have seen a follow through. But that doesn't happen over there. Next day, instead, what happened is price opened inside the range, and then activity started developing. That itself a sign that the buyers who shown in the evening, they are not serious buyers. Despite that, we opened not gap down. We say like price opened lower. When I say price opened lower, price is trading inside the range, but it would have opened down some 30 or 40 points down, but it is not a gap down. I say gap down means price has to open down below previous day low, or it has to open above previous day high if in case of a gap up. In that case, we'll consider as a gap up. So in this case, price still opens inside the range here, started doing a lot of activity, and then it spiked down. It took the previous day low, and you see that initially point of control would have been here. Initially point of control would have been here on 2nd of Jan, and lately price went down. There's a lot of activity. Point of control migrated down. Again, you can see that point of control is migrating down. Value area is migrating down. Value area is overlapping to lower, and again lower. Right, so value area is completely going down and down and down and down. That's what it is. In a good trending, downtrending market, we'll be seeing value area going down. Whereas in a good uptrending market, you'll be seeing value area building higher. Value area will be keep building higher. Whereas in a sideways market, you'll be seeing value area completely overlapping. At times, you'll be overlapping for 3 days or 4 days in a row or 5 days in a row, where the price will be doing some activity here and it will be doing some spiky activity, but value area will be still overlapping in a sideways situations. Whereas in a trending situations, you'll be seeing a good buying interest. When good buying interest is there, the value area also shifts higher, higher and higher. Right? There are days where the value area will be having a crisscross. In a sideways market, you will be seeing this kind of crisscross. One day value area will be higher, again next day lower, again little bit of lower, again higher. So it will be having a very confused overlapping in a congested zones. In a congested zones, you'll be having a mix of value area. In a sideways market, you'll be having an overlapping value area, and in a trending market, you'll be having an value area building higher. So one of the worst thing a trader you should do is that where tomorrow value area will build. Don't try to predict where the value area will build. Let you allow it to the market. Let the market build wherever the value area it's supposed to build. Right. So what you have to observe is where the value area is happening right now relative to the previous day. So we are talking about market observation, right? One of the observation is where the value area is getting built relative to yesterday. So we talked about, so one of the key thing is where point of control is getting developed, that we looked into it. We also look into market profile, normal profile and split profile, but majorly where today's value area, or we can also call this as a developing value area is getting formed relative to previous day's value area. This is what we'll be looking into it, and what we will not be looking into is not concerned about precise levels of value area. Value area has two levels. One is value area high, we call this VAH, and VAL, value area low. We are not concerned about the levels. We don't trade that kind of levels very precisely, right? So some people, the new beginners, they'll be very much obsessed. Every day they will record the previous value area high. They'll be recording the value area low. That's what new beginners will do. But we are not concerned about what exactly the value area is or levels are all about. We are only concerned about the context. So we are concerned about whether the value area is building higher or lower, or overlapping to higher, overlapping to lower, or overlapping. So probably the value area can come up with, so value area can do any one of these things. Either value area can, so value area formation, right? So either it can be value form higher, or value formation can be lower. Third is overlapping to higher. Fourth is overlapping to lower, and fifth is overlapping. So value area can do any of these things, and we need to measure where the value area is forming relative to previous day, or relative to last 3 days, or relative to last 4 days, something like that. Okay. Now again, let's get back to the PPT here. Next comes the buying tail and selling tail. The buying tail is nothing but, let's say we'll take any profile distribution. Let's say the profile distribution is like this, and we may have some tails at the top and tails at the bottom. The tails here are nothing but only one letter would have been got traded, either letter B or letter K or L, but only one letter would have been traded horizontally, not two letters. So if it is two letters which got traded over here, we don't consider that as a tail. But if it is only one letter getting traded at the extreme top and extreme bottom, that we call it as a tail. So we call this as tails. The top tail is called as a selling tail. It's selling tail, whereas the bottom tail is called as a buying tails. And it should be single print. It should be single print means it should be horizontally. If you find here, you'll be seeing only one TPOs, only one TPO. If you find there are days where you don't find tails at all, so those tails we call that as a poor high or a poor lows. So not every day it comes with a tail, but there are days you may not find tails at all. For example, let me show you from the live examples. So let's take this recent example here. You see the buying tail here, the letter D. Letter D, it's almost 1, 2, 3, 4, 5. 5 times a single prints got traded. So a single letters. Only one letter you are finding at the top. Whereas you see that here it is 2 TPOs. Here it is 2 TPOs. If you are finding such thing, we don't call that as a tail, but the last TPO edges here, we call that as a buying tails. We call that as a buying tails. Right, so it's something like a candlestick wicks. Instead of wicks, we call this as a tails. Whereas if you look into third January activity, you see that only the letter K and M, the bottom, that's what the day's low is. That's what the day low is, where we don't have the such tails. It's lack of tails. When you have lack of tails, that's what that low is called as a poor low. That low is called as a poor low. Right, so poor low, again, it is a sign of short-term buying. So short-term buyers would have bought over there. Maybe we will dig deeper into it later on. As of now, we look into the basics. At the same time, you see on the top, that particular day's top also something interesting over there. You see the day's top is also only one tail is there. Only one TPO is got traded over there. Right, so at the tail, whenever only one TPO is got traded or there are no tails, we call that as a poor high. Poor high. That particular day is a poor high because it is something like the price went down. It came exactly or 1 point very close to that particular day's high. Again, it fallen down and it does some activity on the downside. At that particular day high, two letters got traded here. Letter A got traded over here, and probably again letter C got traded over here. The difference is only one tick, and there is only one TPO got traded at the tail end. So if it is only one TPO traded at the tail, or there are no TPOs, no TPO at the tails, then we call that as a poor high. If it is happening on the day high, if it is happening at the day low, then we call that as a poor lows. So poor low and poor highs are the signs of short-term trading activity. Again, there is some trading money is involved. How a trading money is involved over there? It is like price is doing some activity. Let's say if you take a 5-minute chart, it will be looking like this. 5-minute charts, price is doing some activity. Probably this will be around, let's say 11 o'clock. 11 o'clock, this is your day high and this is your day low. And exactly it goes to the day high and probably exactly or 1 point above or 1 letter below. Precisely from there, it used to fall down. So somebody watched the levels very visually over here. So already they know that this is the day high. Price went exactly to the day high, or just very 1 tick shy of it, or 1 tick above it, and precisely it falls down. So who are taking trading decisions here are mostly short-term traders. An investor will not wait for the price to come to a day high and then they will not invest in Reliance for next 5 years. Right, so an investor will never wait. Let's say I want to buy for next 3 months. I'll not wait for the price to come down to today's low or today's high so that I can take my decisions. But someone here is precisely taking a decision exactly at the previous day high, and the price is stopping down. From there onwards, more momentum happens on the downside. It's mostly driven by the short-term community. Or some form of trading money. Some form of trading money is involved in taking decisions there. It is not investing money's decisions. And that point is important because most of the time the trading money, wherever they're initiating the trades, they are supposed to revisit back. They are supposed to revisit back, right? So if you clearly look into the most of the poor highs and poor lows, those price levels are quite important. That says that trading money is taking a decision over there, right? And oftentimes the poor highs or the poor lows are meant to be tested or meant to be revisited back. They're not part of our strategies, but they are indications that short-term buying is on or short-term selling is on. So what kind of players we are dealing with, it helps you to understand. Okay. So in the one of the session we've seen, right? So one of the letters where we seen the 4th Jan activity, not 4th Jan activity, but we looked into this activity, right? So this particular day's activity where the letter E and F and G, they are more of buyers who came at letter E and F period and G period. All these are intraday buyers, right? So we are able to gauge from the price activity. Likewise, we'll be also able to say that the one who came at the poor high and poor low are short-term traders, are short-term. Here they are short-term buyers, short-term sellers, and here there are short-term buyers are involved in the markets. So there are many places where we'll be able to spot such kind of behavior, where we'll be able to explain what kind of players these guys are and how they are positioned in the markets. Based on how the other participants are positioned in the markets, where they are positioned, at what price they are positioned, based on that we can take better trading decisions based upon how these participants are positioned in the markets. Of course, every time they will be positioned differently in the markets, and based upon how they are positioned in the market, it's like if you take a cricket match, right? So the captain will place the cricket players in the field, the fielding settings. Based on the fielding settings, the batsman can take his drive. Based on that, how the other market participants are positioned in the markets. If they are weaker participants, how we can take a trading decisions. If they are stronger participants, how we can take a trading decision. That's what the market profile tells you. It shows you the field settings. It shows you how the participants are positioned in the field. So based on that, how you have to how you have to position yourself in the market. Whether you have to position against them or you have to position in line with them, right? So that is what going forward you will be learning those stuff. Okay, again coming back, I guess we are clear about buying tails and selling tails. So we need minimum more than 2 TPOs to call as a good tails. A good tails, we'll say that it's a good buying if it is more than 2 TPOs. If it is more than 2 TPOs, we call that as a good buying. We call that as a good buying. Okay, maybe I'll put it down in the notepad. I'll be sharing you all these things in the Slack as well, so that you can make use of those information. So buying tail, a good buying tail, we call that as a good buying. That doesn't mean it's a buy. So we call that as a good buying if tail TPO size is more than 2, then we call it as a good buying. Whereas lack of tails are 1 TPO at the tail, then we call that as a poor low. So tail will be coming usually at the lows. Buying tail will be usually coming at the day's low. Whereas the selling tail usually comes at the day stop, and we call that as a good selling tail if TPO size is more than 2, right? So, and lack of selling tails, we are only 1 TPO at the tail, we call that as a poor high, right? So that means it is called as a poor high because a good tail is nothing but an indication of the end of an auction. That day's auction got ended. A poor, if the auction is getting poor, right, you will be finding that the tails are not presented properly. Probably you will be seeing only one TPOs at the tails, or there will be no TPOs at the tails. That is a poor way of auctioning in the market. So if you are finding a poor low at the top, let's say this top is a poor low, it is not a very good auction. The auction is not completed. Probably all in a sudden short-term players are reversing the positions from the poor low. So those levels are meant to be tested in the subsequent days. Like, so that is one of the reference you need to carry forward. Right? That is a short-term reference, and those reference will be, price will be coming back to the reference. We call that as a revisit of the levels. That means generally price comes to clear back those references, right? So to complete the auction. So it's one way where you can spot an incomplete auction. It's one of the way where we will be able to spot an incomplete auction. That is why it's termed as a poor low or a poor high, because it's a poor, the auctioning is done in a poor mode. It's not a good auction. A good auction will have at least, that's why we will call that as a good tail. A good tail which is more than 2 TPOs or a 3 TPOs or a 4 TPOs, we call that as a good buying. Right? That means the auction is good. It's a completed auction. Whereas a poor low or a poor high or incomplete auction, and those auctions are likely to revisit back most of the times, not every time, but most of the times those poor lows and poor highs are meant to be revisited. But we will not speculate whether the poor high will be cleared or poor low will be cleared. We don't speculate. We use poor high and poor lows only to understand what kind of trading behavior is going on. But yes, poor lows and poor highs are meant to be revisited, but you never know when it's going to revisit back. It may happen the very next day, it may happen within a week, or it may happen 1 month, and very rarely it can go to 3 months or a year. So we don't care about it, but that is a reference. We need to carry forward those information. Whenever there is a poor high or a poor low, as long as it is not tested, as long as those price levels are not tested, you need to carry forward those information to the subsequent trading day. Right? Any questions here on poor lows, poor highs, or buying tail or selling tail? Anyways, we'll be talking about poor lows, poor highs in detail. But anyways, the next comes the single prints. Next comes the single prints. Single prints are something like market does some activity, and all in a sudden you'll be seeing a nice spike, and again activity builds higher. So if you look in from the profile distribution perspective, you'll be seeing like this. Your profile will be looking something like this, where these zones are only one TPOs got traded at each and every price interval. Maybe you'll be finding only one letters there. Letter G, you'll be finding letter G or letter H or letter I somewhere in the middle. And each and every, other than G, none of the letters would have been got traded over here. Whereas here, if you see, there will be more activity happening horizontally, more activity happening horizontally over here. But in between, the distribution will be separated two different distributions. This is distribution number 1, and this is distribution number 2. Both these distributions are separated by only one letter. One letters. So it's tough to write here. So anyways, it's my bad handwriting. So one letters would have been got traded over here. That single prints, again, that is a very crucial information which you'll be able to gather. So based on that, we'll be drawing the reference lines, which I'll be explaining in the tomorrow's session. So when you're finding single prints, that is an important reference level, right? So that is where we'll be able to spot an resistance level or support levels. Those single print plays a dominant role over there in finding an intraday support or an intraday resistance. For example, I can show you one of the example here where how to understand the significance of single prints. Right. So let me take the Nifty futures example. Nifty futures example. You look at the second Jan's activity. I'm gonna Second Jan's activity, you can see a double distribution. So you see a double distribution, which is separated by a single print zones. Probably I think that is at letter G, right? So this is at letter G. You got a double distribution levels. Two distributions, one distribution on the top, market fallen at G period, and that single print zones are not, revisited back on the same day. And then second distribution formed at the bottom. So whenever you're finding this single print zones and market is falling down, that is a good selling. That is a good selling. That is also called as a high confidence selling. One another way we'll interpret confidence. So we already seen that confidence, we use point of control to measure. We use one time framing to measure the confidence. We also use single prints to measure the confidence, right? So it's a good selling. So if it is a good market, if the sellers, these sellers are serious, if these sellers, the sellers at G period, they are entering there, they are very serious. What they do, whenever the price enters back into the zone the next day, price enters back into the zone, they are pushing it down. Price enters the zone, they are pushing it down. So we use this level to monitor the confidence. So that is why I drawn a reference line here. So the reference line here, I'll be drawing on the double distribution. So this particular day we have a single print zones here, and the price went down. So I'll be using the lower. So here is the lower distribution. The lower distribution balance top. I will draw a line. That will be my resistance point. But when it comes to the resistance point, just like every other trader, we don't consider that as a precise resistance. We don't have a stop loss precisely at that level. That is our confidence monitoring level. We use this level to monitor the confidence. Okay, so if it is a good buying, think about it. If it is a good buying, this is one of our confidence level. Okay, so I'll be monitoring my confidence level over here. So what was happening here is that it is not just previous day high or previous day low. We'll be monitoring the confidence. We'll be monitoring the confidence, especially at these levels, we have priority to the previous day high or previous day low. You see that price is opening inside the range. Price opens inside the range. Okay. If it is a good buying, what will happen? The very next day, price opens above this and start building activity, and it keeps going up. If it is a good buying, that is a good buying. You'll be finding point of control building above your reference, above this reference, because yesterday sellers take in control, price went down, sellers was in control, they created a single print zones, they created double distribution pattern. If those sellers are serious sellers, they will come and defend. Every time the price goes up, they will push it down. Price goes up, they will push it down, right? So you will find that point of control will never build above this. If it is getting built above this, we'll say like acceptance came in. Price is able to accept above this level. So more activity happens. Your point of control is over here, and activity builds higher. Activity is over here. So with that, we'll say like that it is a high confidence buying. Whereas what is happening here is that price went up, they push it down. I mean, means the buyers are pushing the price up, but they push it down. So I will not say like it's a low, I will say like it is a low confidence. The buyers are doing a poor job over here. Whenever the buyers are doing a poor job here, it is a bad buyer's confidence. It is a good time to look for a mean reversion. So with observing this level, you observe this level, and probably you see that price went up and it pushed down. It went up and it pushed down. These are the signs that whenever at a crucial reference level, whatever you're monitoring here, if you're seeing a rejection, this is what a rejection will look like. Every time the price tend to go above, you get a rejection. And this is a crucial reference level because sellers defended yesterday. Today also they are defending. So you need to be trading against these morning buyers. The morning buyers who try to push the price, you need to position yourself as on the selling side. So if you look into my early morning observation on that particular day, right? So maybe I'll scroll back to the Slack. On day-to-day basis, we'll be discussing about the trading activity in Slack. So if you look into the 3rd Jan activity, my comment will be something looking like this. Let me go back and get the 3rd Jan's activity. So here is the 3rd Jan's activity. 3rd Jan activity, what was happened over there is that so my comment was like low confidence buying. So I don't have access to the charts by the time some issue was there with my internet connectivity. So one of the client, one of the participant here, he posted, you see that by the time there was a double distribution here, there was a double distribution reference here. He marked a line also over here to monitor that reference because it's a crucial line, and price went back and it went down. Again, it went back at the C period also, again, it went down. So it rejected. It's a very first sign we've seen is a rejection. Most of the time it will reject. A double distribution pattern, mostly it will reject. Very rarely it get accepted. In a good downtrending movement, you will be seeing such kind of rejections, right? So always market will give you enough time to exit. Even if it is even if there is an acceptance, right? Price snaps back and it does more activity there, then only you will be seeing, and your point of control will shift here. Then only you market will give you enough time to think about the change, right? So if there is any subtle change coming in the markets, price will tend to stay above double distribution. Price will do more activity above the double distribution reference level, whichever you are monitoring, right? That is a crucial thing here. So I looked into the chart. I'll say it like there was a rejection coming in. Price went up and it got rejected. That means it's a price rejection. So that means it is what? It's a low confidence buying. A low confidence buying means the buyers are doing a poor job here. When the buyers are doing a poor job, basically you need to tend to trade against them. You need to tend to trade against them, trade against the buyers. And your monitoring confidence is what zone? It's your point of control should never ever go above it should not go above the double distribution reference. Means when you are monitoring this reference, you should not see this. Price goes up and does this and it does this and it does more. It's building more activity over there. You should not want that. What you want to see is that when you are seeing a rejection, immediately you need a responsive activity, price building lower, or maybe something like this. Again, price building lower. Again, price building lower. That is where you need to, whenever you're monitoring a reference, when you are able to spot that low buying confidence is coming in, the confidence hardly changes once or twice in a day. It doesn't changes frequently. There are days it never changes the confidence at all. It opens with a high confidence. It remains high confidence throughout the day. There are days it opens with a high confidence, but then all of a sudden it turns to low confidence. But then later on, it will be remaining as a low confidence forever. Right? So maybe we talk about the confidence later on, but what I want to show here is that what is the importance of the double distribution, that balance, the importance of the single prints. Those single prints are playing a crucial level in your trading decisions on that particular day. So this particular day, that means even if I have when I'm seeing a rejection here, I'll be very cautious in my longs. If I have longs, I'll be thinking about closing my trades, or I'll be doing some partial booking and tightening my stop loss. Or if I want to short here, one of the best trade location, wherever you are spotting a rejection, whenever you are spotting such kind of rejection at a major reference level, it is one of your best trading opportunity. Maybe you may take a time to evaluate it. Even though price is trading inside the range, you see that price is trading inside the range. It's trading inside the range. I will term that as a low confidence buying. So your trading opportunity comes over here, or either here, or even if you missed it, your trading opportunity still it comes over here. And all you have to do is that active monitoring, that price should not go above. We never know what the price is going to do. You know only your trade location. These are interesting trade location to take best trading opportunities, right? Let's say I took a trade over here. But instantly price shifted and it started doing letter F, G, H, everything is getting built over here. Then I'll consider giving up my position because something is changing in the market. That means now the buyers might be showing interest. If they're building above the double distribution reference level. As long as that is not happening, you do what the market is doing, right? Don't try to anticipate what you want. We may want 1,000 things from the markets, but if you want to stay objectively in the markets, try to appreciate what the market is doing, and you also focus on the same aspect. Maybe you may be thinking like market might be testing 11,000. The news are good. Everything is good. The China market is booming. The US market is up 2% overnight. Despite everything, despite all the bullishness, you're seeing rejections. That is a clear sign that you have to do what the market has to do, right? Despite what you want, you have to focus on what the market wants. Okay, so that is how we'll be looking into we'll be focusing on single print tails. There are many trade locations, single print tails will come. So over a course of period, we'll be discussing about which are the zones, how to plot references at those single print zones, and how to monitor those zones, when to monitor those zones, how priority we have to give to those single print zones. That is what we'll be talking about it. So the single prints are obviously interesting zones, and those are mostly your next observation points. It talks about the confidence. It talks about how to monitor the next day as well. Okay. Are we clear up to this point? If you have any questions, you can ask me right now. Anything about value area, anything about point of control, anything about single prints, because the subsequent sections will be dealing with this, but we'll be dealing with the combination of information. It's like we're not going to deal with only one single print, or we're not going to deal with point of control. We'll be taking a complete holistic view about how the point of control is forming, how the value area is forming, how the single print is forming, how the profile structure is looking like. So combining all these things, what you can expect from the market. If so and so is happening during a live market, then what we can anticipate from the intraday perspective. That is what the whole game moves on. Right, so we don't look into isolation. Okay, single print is there, it is bearish. We don't put just blindly we don't put such information. How the single print is there, how the trading activity is happening, what level I have to monitor, how the point of control built yesterday, or last 2 days, is there any weaker setup formed, and what the market is doing. What right now the market is doing more important than what happened yesterday. Right, so always the priority goes what is happening right now in the markets. It doesn't matter. You may have weaker setups. Like one of the things is like there is a point of control would have been formed, and one more point of control would have been formed. This will tells you that market should rally higher. But despite that, market would have opened gap down, and it would be started showing high confidence. In such a case, you should be in a position to trade what the market is doing right now. Maybe your expectation, this will be your expectation. The expectation here is that you'll be anticipating a short covering rally. But at times what happens, not every time the market goes with your expectations, right? So based upon your past knowledge, past market profile knowledge, your expectation here is that market want to do a short covering rally. But what market would have done is that market would have opened gap down, but still this odd stays. But what market does is that usually it will try to, let's say this is one of the confidence level you're going to measure. Initially, it would have went down. So maybe it's not if you're looking for long, still it is not a good place. So it would further went down. Confidence would have been higher. Further it would have been went down. But lately there will be short covering comes in, and the point of control builds here. Point of control shifts over here. Your POC formation would have been here. So that is a sign that this markets, the sellers who are showing interest, they're losing control, probably because price now enters into the range. price is doing more activity here. Point of control got shifted into the range. Now you can expect what you expected. Now you can expect what you expected, right? So based upon our market profile knowledge, we'll be gaining what to expect from the markets. We might have, based on that, we'll be building our bias, we'll be building our view. But if market is doing something else, we should also change accordingly what the market is doing. Like maybe the market opens gap down, it would have been completely went down throughout the day, right? So, but it will tend to do what you want, but definitely at what time you want it, market will never do all the time. Based upon your market knowledge, we know that this is going to happen, but when it is going to happen, we never know. It will happen, that we know. If you want to know when it will happen, you have to just follow the path of the markets. So like a GPS, whichever the direction market moves, you should be in a direction to move accordingly. Now let's say the market opens with a gap down. So your focus is on the downside, immediate focus is on the downside. If the market opens gap down, let's say if they are not serious sellers, they would enter back into the activity and they do more activity here. That is a sign of that is not a good selling. That's a poor way of selling it, right? So if they are good selling, what happens? Let's say this is one of the reference level you're monitoring. If it's a good selling, probably let's say this is what market done yesterday. It went down, and if it is a good selling, the selling would have been, once the level broken, more activity would be forming lower. That is how the point of control will be shifting lower, and the activity remains same. Maybe once it comes up, or twice it comes up, but it falls down. But point of control will never shift on the upper side. Point of control will be will be trading below that reference level, right? So those reference level, I'm repeating again, they are not stop loss. They are monitor level, only to measure where the point of control, where the price activity is happening, either above that level or below that level. Right? Based upon that, we'll be able to develop the context and we'll be able to trade in the direction, whatever the direction we want to trade. But whereas when it comes to the new traders in the markets, they play the exact game. Like if they see that as a support, they want the support to be exactly touched and then it has to bounce back. And that is how the new buys play. They want something to happen very exactly. But who are playing that exactly, they are mostly weaker hand traders. So what market often does is that every time you see that exactness, market goes and revisit those exactness plays. So it's like you might see sometimes price comes exactly to 10,700 exactly, or 10,701 or 10,700.5, and then it bounces back exactly. So those are the places, they are mostly initiated by the trading money. So trading money plays those exactness, right? So as a trader, we are not focused on exactness. We are okay with these kinds of whipsaws. So let's say the price went down, your point of control is building lower. Almost 4 TPOs got traded over here, and lately price little bit of spike and again rejecting back. We are okay with that. So means we are not having a stop over there. We are just monitoring that as a reference to check whether the activity is building lower or higher. Based upon that, we will be position ourselves in the market accordingly. Yes, I can take some questions. Repeat on single print. Okay. Okay, let me repeat single prints again. Single prints are crucial information, right? So single prints are crucial information. As a market profile trader, we value single prints. It tells a lot about the market confidence. If you are finding a good single prints, right? So mostly you will be finding a double distribution. A double distribution will be like, we'll be having one distribution and followed by a second distribution. Like, anyways, we'll be talking more about this. Tomorrow's session, we'll be talking more about this. If it is a downtrending market, we will take the bottom of the distribution as a reference. So here you'll be finding only one letters would have been traded here, letter G or letter K, or only one letter would have been traded horizontally. Horizontally, if you see, there'll be only one TPOs at any given level. Those levels, those block of single prints are very crucial because that particular day, so since the sellers controlled in this day, the sellers push the price down they never got back up. So most of the days activity, what happens when they are pushing it down, you will be finding an two-way auction process. We call that as a two-way auction process, where price plunges down, they push it back, and where you'll be seeing letters A, B, and C, and D. That kind of horizontal widening happens over there. Whereas here, there is no widening happens. They push the price, they maintain that level. They maintain that level. So that level is a resistance kind of resistance level for the very next day, or it's a short-term reference level. There are some of the reference level we classified as intraday reference level. Those levels are valid only for intraday. Some of the reference level we'll classify as a short-term reference level. Those reference levels are valid as long as price is not building above, point of control activity is not building above that. So as long as it is not building above that, we keep that reference forever as long as that level is not breached. Right? So as long as maybe price went down, it got rejected and it keeps moving down, I'll still keep this reference level. Still the reference level will be active. Whereas I will erase this reference level. Let's say price moves up, it does some activity and it started building activity higher. In that case, I will cut off this level. I will cut off this reference level. So one of the key skills is how to plot the reference level, when to keep the reference level, when to remove the reference level. That is again a key activity. Again, I'll tell you how to deal with this reference level in a very objective manner. And as of now, I guess you would have got some understanding about those single prints. Those single prints are very crucial. Single prints can come at the day high also, day low also, right? But the single print which is coming middle of the profile is what we value more. Yeah, any other questions?
Rajendran, this is Sampath here. Can
Yeah.
you hear me?
Yeah, tell me, Sampath.
Yeah, instead of Nifty, you can take a reference as a bank Nifty and you can explain because the volatility is very high. So that
the same rules applicable to any kind of markets. It's not just Nifty or Bank Nifty. Let's say I'll duplicate the slide and I'll pull up Bank Nifty. It doesn't matter. We'll be tracking Nifty and Bank Nifty activity in Slack. And you change the symbols, automatically it gets calculated for Bank Nifty. Anyways, further explanation, I'll continue with Nifty and Bank Nifty. Anyways, the very next sessions will be mostly dealing with Nifty and Bank Nifty. You see that again, you have the distribution levels over here. The distribution levels over here. When you are seeing a distribution levels and it is separated by a single print, so there is a single print in between. Okay. So single print again, it's coming at a G period. So what I'll be doing is that I'll be drawing a reference line. I'll be drawing a reference line at this reference. So exactly at this reference, I'll be drawing it and I'll be monitoring it. So I will never tend to go positional longs or intraday longs. I mean, as long as I'm not getting any activity above this. If it is, I'm getting more activity, I'll be mostly position myself on the upper side. So otherwise, I'll be having a different view in the markets. I'll be having a different view in the markets. So my view changes with what market is doing. You're getting my point? Yeah. My view changes here based on what the market is doing. So I'll be positioned differently if the trading activity is this as a resistance. I say that this is a resistance, right? This is a resistance zones. If the resistance zone is there, price is doing something else, then I'll be positioned differently in the markets. But I would be positioned in the long side if, let's say, price opens here and activity is coming over here and more activity is coming here, some sign of confidence is coming here. I won't take any, at least whether I am positioning long or not, I will not position myself into a short position. That is one of the bad way to get into a game. So if once you've seen that price started accepting above the double distribution balance, more activity is coming above the double distribution balance, they are one of the worst places to hold a short here, right? So you'll be able to evaluate yourself. Should I have to position yourself in a short mode, position yourself in a long mode? Is it the best time to get out of it? You'll be able to assess yourself based upon what are the logical rules which we are going to talk tomorrow. Yeah.
Rajendran, one more question. In this profile, what you are shown now, Bank Nifty.
Yes.
On the right hand side, if you see Jan 7th profile already is there.
No, that is not Jan 7th. Actually, it is a split profile of the 4th.
Okay, okay.
So maybe tomorrow market opens, this split profile will goes away, and you'll be seeing Jan 7th profile on Monday.
Okay, okay. Thank you.
Yeah.
Rajendra and Rohit here.
Yeah, tell me, Rohit.
So when we open the Nifty chart, so when you showed that the double distribution,
Yes.
so we can see a long buying tail. So was it a confident
On which day?
that we can see a buying tail there?
So you're talking about this.
Yes.
See, from an intraday perspective, you never know whether it's a tail or not. Maybe it might, again, it could have been broken. Or end of the day, also, if you're looking into it, we don't speculate from the buying tails or the selling tails.
Okay.
But only thing is that whether the auction, what kind of participation is coming in, that's what I'm talking about. So this is a good auction for the day. It's ended good. That's fine. It's over. But this auction is not ended. This auction has been ended poorly. So who is controlling this auction? That's what I'm more interested in it. I'm more interested in it because it's done by trading money. It's not by some other investors. It is not, investors are not taking trading decisions over there. Who is taking trade decisions is mostly short-term players are taking decisions over there. So that auction is incomplete. Maybe the price may want to come and revisit back those reference levels. That is one clue. That is one information talks about what is going on in the markets. Who is controlling there?
Okay. Thank you.
You're getting my point. So we don't speculate on the tails at the top, or so it is one way of. So these are basic terminologies. From the basic terminologies, we will not speculate. But there are things like the poor highs. We'll be able to derive context. Who is doing what? A good buying or good selling, it's just complete of an auction. It's a good auction, nothing else. So you'll be able to classify that's a good auction, and this is a poor auction. That is a poor way of auctioning in the markets.
Okay. Thank you.
Yeah. Any other questions? Okay, if we don't have questions, then we'll move on to the next topic. So we talked about these basic principles. So one of the principles we left out is the initial balance. Initial balance, these days we don't care much. In the olden days, it was very interesting because the initial balance talks about the first 1 hour range. First 1 hour range. These days, we kept a low profile on monitoring initial balance. In our previous sessions, yes, we had some, we given some importance to the initial balance, but over a period of time, we kept a low profile on initial balance. When it comes to the initial balance, right? So it's nothing but the first 1 hour of trading activity. Why it is so crucial is when the market opens, mostly the trading money are the one to flood first in the markets. They'll be waiting for the market to open. So when the 9:15 starts, they are the first one to jump into the markets and jump into the bandwagon to take a trade decisions. So because most of the traders, they can't control themselves to take a decision. Somehow they will analyze the chart. Somehow they will come to an overnight itself. They would have been went through the charts. So when the market is about to open, they are ready to buy something in the markets, about to buy or about to sell something in the markets. So it is also called as in the first 1 hour of trading activity. You can see more volumes happening. If you take any trading activity, let's say the price is doing something else, right? So you might be seeing most of the, at the first 1 hour, you'll be seeing a good volume activity most of the days, not every day, but most of the days, the volume will be very higher at the open. The first 1 hour will be mostly it will be dominated by the trading community, the small trading community. And the last 1 hour, so middle of the day, you'll be seeing mostly very less volumes and probably spikes, sometimes spikes in the middle of the day. And the last 1 hour will be mostly dominated by the mutual funds and institutions mostly, because that's how they say, like smart money plays at the last 1 hour, and the dumb money plays in the first 1 hour. That doesn't mean like you should not play at the open. There are days you have to be at the day's open itself, but most of the days, your best opportunity comes during the middle of the day. It can be around 11 o'clock, it can be at 12 o'clock, or it can be at 1 o'clock or 2 o'clock. You never know. But if the market itself showing confidence right from the open, so those are the zones where you have to be taking a trade. But if the market itself not showing a confidence neither on the buying side or the selling side, you should learn to wait, and you should learn to wait, and you should be waiting for the opportunity to arise. Most of the opportunities may be coming in the form of an poor buying confidence or a poor selling confidence that may come during 10 o'clock or 11 o'clock or 12 o'clock, or it may not come at all. So when the opportunity arises, right, you should be in a position to trade, but not every day your opportunity is going to be best at the open. But there are days like your opportunity will be best at the open. Maybe at times it can come in the form of a runaway gap or a gap up, and then it moves in with a good confidence. It spikes up and then it keeps moving in one direction. So you need to be an two kinds of player here. One is a fast thinker who at times you have to act really fast in the markets. At times you have to wait for the opportunity and take the opportunity as it comes. Like you have to wait for a slow, that'll be kind of a slow trading activity where you are willing to wait for the 1 o'clock to come and the market to show some activity and the best opportunity is coming there and you want to take a trade over there. Yes, Nitin, you have some questions there. So, but the first 1 hour is mostly dominated by the mostly trading money. I will not say dumb traders because it is nothing but one guy is on the buying side means another guy is also on the selling side. So mostly trading money plays at the first. The trading money initiates the trade first in the first 1 hour, and the last 1 hour will be mostly initiated by the institutions. So institutions here and trading money here. So trading money here. So, but what I'll be interested in checking whether the initial balance is building on the downside. So what is the initial balance direction? Is the price opens the letter A and B, how it is getting positioned. So is the initial balance direction is down or up? That is what we look into it. But what many traders they will do is that they will be mostly playing the same open range breakout policy. So they'll be having in first 1 hour range, market would have done this. By that 1 hour range, letter A and B would have been formed. Letter A and B would have been formed. And most of the traders, they again come and trade these levels. The first 1 hour levels, buy and sell levels. If it breaks, then it is a buy. If that breaks, that is a sell. That's how the trading money plays. The trading money will be watching some level. When that level breaks, they will go for a buying. When this level breaks, they go for a selling. And they are precisely some form of levels. It could be an 200-day moving average. It could be a Bollinger Band levels. It could be a trend line levels, right? So the trading money, what the trading money mostly watches is these kinds of levels. So what the trading money watches, if you don't have any questions, you can mute yourself.
Hello.
Yeah.
Sir, like how in the early hours, how to know the market is it like is going to be a good like a buying confidence?
We are going to talk about it later on. First, we are just in the basic. We are talking about the basic terminologies. Once we complete the basic terminologies, we advance to the next level, and then to the next level, and then to the next level. So,
okay, so
we'll definitely will be going through that. Okay. Now, right now, what we are talking about is how the trading money behaves. At what level they will be behaving. Right, they'll be mostly coming at the trading money will be mostly coming at day high or today's high, today's low, today's high or today's low. Where you'll be able to spot out our previous day high, or previous day low. They'll be also coming at many people watches these 200-day moving average, 200 moving average. Maybe they may come around those level. They may be interested in multi-day high or let's say the price is coming and touching exactly the 2-day high or 3-day high or a 4-day high, multi-day high or low. They'll be coming and if you are seeing multi-day high, let's say 2-day high, price is coming and touching exactly the 2-day high and then it's bouncing back. Again, it's mostly trading money is involved over there. Trading money would like to initiate a trade when there is a trend line breaks out. So maybe the hourly trend line breaks out or a daily. Many people watches this, right? Probably you can see This is how the markets would have been. And they would have been drawn at trend lines. They would have been drawn at trend lines like this, and they'll be waiting for the trend line to get broken. When the trend line breaks on a hourly charts or a daily charts, most likely the traders will be watching those reference level, and they'll be waiting for the price to come and break. They will take a trade, or when the price comes and touches the trend line, they want to initiate a trade over there. That's how the traders, most of the traders, they behave in that way. And they may also come at, some people have a habit of watching the Bollinger Bands on the daily charts or hourly charts, Bollinger Bands. So when the price touches the Bollinger Band levels, when the price touches the Bollinger, let it touch the upper band, price touches the upper band, and then it's coming back. So traders might initiate a trade towards the mean reversion. So that's how some of the traders position themselves. But most of the levels, most of the traders, by either knowingly or unknowingly, they watch these levels. They watch these kinds of levels. So that is where they behave very mechanically. And that is where you'll be able to see at certain places, you will be able to see that poor highs, poor lows. And there are many places where over a period of time where I'm going to show you how the trading money behaves. So where you'll be able to spot the weaker hand traders behavior, and you will be able to evaluate the stops. So for example, I can show you one of the auction which happened in Nifty. So how the players behave. So this was precisely happened on 1st of January. 1st of January, right? So if you look on 1st of January, so one of the places, the market ramped up lately, but before market ramping up lately, you can see the letters. You can see the letters on 1st January, the letter C, letter I, letter J, all are coming at exactly at the same level. Exactly at the same level. In fact, it is coming exactly at the 28th December low, just one point below the 2-day low. 2-day low, exactly. Buyers are watching that 2-day low as a reference. Maybe somehow they are watching as a swing reference level. They are initiating the trades not one time, not 2 times, but 3 times. Player came very mechanically over there.
Hello.
Right? Yeah.
Rajendran, Harsha here. So are you trying to say, try to avoid trades here, right? Means near.
No, I'm not trying to avoid trades here. Record your observation here. What I am saying is record your observation here. This is one of the information which you are going to say that is some sort of stop loss is sitting below that. So all the trades who are initiated by these traders are mostly trading money. Trading money is involved over here. What I'm saying is this is how the trading money takes the decisions. See, what I want you to focus on here is don't focus on where to initiate the trades. Market will definitely show you somewhere else. First, as if you want to be a good market profile learner and order flow learner, first you learn to understand what is happening at that trade location. Who is responsible for those trading activity? Then only you will be able to assess the scenario. Then only you will be able to know what is the field settings. Like in a cricket match, how the field settings are there. These are the field settings I'm talking about over here. Right?
Okay,
so
sure.
once you're able to assess those field settings, then you know how to position yourself in the markets. So if you want to know me on that particular day, how I seen the markets. So let's go back to the Slack, and it's 1st of January, right? So 1st of January. So we track that information. So here. So my assessment was like this. It's, you see that? Maybe I can zoom it and show it to you. That particular location, I marked that as that location as a stop. You see that? The letter C, letter I, and letter J. Exactly at the precise point, I marked that as a stops, and price went up. Price went up. That particular day, we have a view that this is not a good selling. This is not a good selling because volumes are not supporting. It is breaking 2-day low. So that 2-day low I marked as a reference here. This is a 2-day low here. If it is a good selling, what happens when the 2-day low is broken? Activity should build lower. But instead what happened, my point of control is getting built over here. Volumes, when the price is breaking 2-day low, volumes are not supporting. volumes are supposed to support when the price is breaking 2-day low or a 3-day low. So volumes are not supporting, so which you will be able to assess from the order flow charts. Maybe I can brief you on some other day. So we are initially positioned short, but once the 2-day low is broken, we are waiting for something else to happen in the market. We are waiting for some serious sell-off. Serious sell-off doesn't happen, but then all in a sudden, price took an upturn. But that upturn, you see that the letters C and I and J, it behaves very mechanically, right? So that is why we'll be able to evaluate the stops. So our reading goes like this, so stops at the letter CIJ reference level. They are weaker reference levels. It's weaker reference level because multiple times. It's not one time. It's not 2 times, 3 times. The players are initiating a reference level. Exactly, someone is monitoring those reference level. And they are trading decisions. They are taking a trade decisions. They are mostly weaker hand traders, and their stops are built below that levels, right? And so still one more stop pending. So there are many reference level we are watching out. One of the reference level we are watching out is 10,850 levels from the market profile perspective. And we anticipated that 10,850 to break, right? Okay, maybe we talk about this. All these things are not necessary at this point of time. So one of the things you have to monitor, that there is some stop which is a weaker stop which is built. So there is a high possibility that that level can be revisited. So maybe if you are long, if you position yourself in the long in the markets, that one information you have to remember it, because anytime market can go down to test those levels. When it is breaking, it breaks really hard. It breaks really hard, and it breaks at the G period. You see the break which is coming there the very next day on 2nd of Jan. It breaks really hard, and that's where most of the stops already would have been in the market. It would have been triggered by this strong break. If you would have run the market replay on 2nd of Jan, you know that when you're watching that level, how it is breaking, you'll be able to justify that it is a stop. We call that as a stop hunting. So usually some liquidity will be sitting over there. Most of the people tend to have a stops in these zones, mostly in the form of pending orders. All those pending orders would have been broken. When the price breaks at G period, it triggers a good amount of liquidity. It removes all those weaker hands from the markets. I mean, that's how the trading money mostly position themselves in the markets. Right? Okay, now let's quickly get back. So the initial balance will be mostly shown in the form of you see a small stripe which is attached to the profile, and vertical stripe. So that vertical stripe, it talks about where the 1 hour activity is happening, right? So mostly what the dumb money is doing in the first 1 hour. So we don't take any much of the context from the first 1 hour, but it's simply an basic market profile criteria, basic market profile terminology. And it's nothing but the first 1 hour range. Point of control, we call point of control as the fairest place to conduct any business. Every day, the buyers and sellers will be doing some business. The institution will be buying or selling something. They'll be adding to their positions or removing to their positions. The speculators will come and speculate. But every day, when the buyers and sellers are coming and colluding, market does some balancing activity. With an equilibrium point at the center, right? Not exactly at the center, but where the maximum activity is happening. That is where we say, like, that is the place where more number of buyers and sellers are agreeing to pay a fair price to that for that particular day. So this is what we call as a fair price, where more people or more trading activity happens, more people are agreeing that it is a fair price for the day. Whereas at the top, you see, at the top or at the bottom, the activity is very less. The trading activity is very less. Here, only one TPO you can see. Only one TPO at the top and one TPO over here. Whereas 10 times the price got revisited over here. So the top and the bottom, we call that as an unfair price. It's an unfair price because not many people are interested in that auction. To explain this, we can take any classical auction. Let's say an art auction. If you go to an art auction, or if you go to an horse auction, or if you go to let's say an classical Sachin's bat is coming to the auction, right? And you people are on the audience side, and once the auctioneer shows the Sachin's bat, and he says like 10 lakhs. The moment he says 10 lakhs, in the participant side, whoever want to take the product, whoever want to bid for the auction, they will be thinking about what will be the fair price of this bat. So it's Sachin's bat anyway. So maybe I can buy it outside. If you're not a Sachin fan, you'll be thinking like this. Probably I can buy this bat anyways. This MRF bat I can always buy it from outside. So why should I have buy this Sachin's bat? But if you're a Sachin's bat, if you're a Sachin's fan, you might be thinking in different terms. Oh my God, it's a Sachin's bat. Maybe at any cost I should be buying this. Should I have to bid 11 lakhs or 12 lakhs? So this is what it will be going in everyone's mind. Everyone will be thinking about what is the fair price. But in terms of market, everyone will be thinking the same terms. In the market, let's say SGX Nifty is currently around 10,880. It was almost 150 points higher. So everyone will be thinking about, let's say Monday market is opening 100 points higher. Everyone will be thinking about, should I have to wait or should I have to buy now? Should I have to wait for the price to respond lower initially so that I can buy at a lower price? That's what everyone will be thinking about, right? So everyone want to join the auction. So when the Sachin's bat is coming into the auction, all in a sudden one hand goes up, 12 lakhs. So he's the first one to kickstart the auction. Now that garners everyone's attention because now price started going up. When the price started going up, now the Sachin's bat is now worth 12 lakhs. So everyone will be thinking about, oh my God, the price is going up. So now everyone want to join the auction because the auction kick-started. So now the price moves to 12 lakhs, 12.5 lakhs, 13 lakhs, 13.2, 13.3, 14 lakhs, 15 lakhs. As the auction kick-starts and the price started moving higher, it pulls more participants into the system because now many people will value the price. Many people will do transactions, and as the price keeps going up and up and up and up, let's say it goes to 15 lakhs, 20 lakhs, 25 lakhs. At 25 lakhs, now very less people will be interested at that auction because not many people will consider that as a fair price. For some people, it will be an unfair price. So that is why something like here, you'll be seeing like very less activity which was happening there. Whereas as the price goes higher, like a Sachin's bat, you'll be finding at the top only one buyer will be showing interest, and after that there are no buyers at all. So he's the last one to win the auction. That is a clear one-way auction where as it goes up, the volume decreases. You see that the volume is also decreasing, means the participation is decreasing and the participation is least at the market top. At the day's top or at the day's bottom, you can find very less and less volume happens. Right? This is how a typical auction happens. That's a one-way auction, where only in Sachin's bat example, only one guy will win at the top. Maybe he might get at the 30 lakhs, he might win the bat and he take the bat home, where he's the one who comes at the top, which is, he takes the unfair price. That is a one-way auction, whereas that auction is completely driven only by the buyers. But when it comes to the market, you can find that the buyers initially driven the auction up. Lately, the sellers are driving the auction down. This is a two-way auction process. So this two-way auction process you can see in the market all the time. Like market never moves up like this. If you see any profile, most of the profile will not be keep on moving like this and like this. It never keeps on going up and up and up. It never keeps going up, 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 up and up and up. It used to happen in the market, but it's very, very rare. If you take most of the days, 90% of the days or 95% of the days, market will not auction like this. Market will be auctioning initially the buyers will be moving the auction. Lately, sellers will be pushing down the auction. And again, buyers will be moving the auction up. So this is how the two-way auction, because of this two-way auction process, we get a profile distribution. We get a profile, nice, clean, balanced distribution, right? And whenever the price is moving away from the center, like this is where initially you see that letter A, B, C, D, your initial point of control is established over here. Price is moving away from the point of control, and then price is again plunging back to the point of control. Price is pushing down, again price is coming back to the point of control. Overall, the point of control remains the same. That particular day, the point of control never migrated. Right from the ABCD balancing point, right from this ABCD balancing point, price moves away, it comes down, it went down below, it got back into this references. So one of the things what we'll be monitoring is that where the value area for the day is and how the price is positioned relative to the value area, right? So we not only watches the price here, we'll be watching price relative to value area and the point of control. So let's say price is moving down below the value area. Mostly emotional sellers come and sell over there. When the price is going above the value area, as an intraday perspective, you have very less odds of continuation. Most of the time, only emotional buyers are going to get trapped. Or most of the times, price plunging below the value area is more crucial because most of the time it rotates back. So what you should not do is that selling, once you see that the price is plunging below the value area low, you should not initiate a fresh short trade over here. You should never initiate a short trade here. That is a bad way. Mostly emotional traders initiate there. Usually price got back into the value area from an intraday perspective. So that is a poor trade location to initiate a trade there. Right? So most of the time contra trades happens over there. Most of the time from an intraday perspective, market reverts back into the value area. Right? So what usually happens is that the value area would have been developing for the day and price would have been doing something else. All in a sudden, some news comes, there will be a drop. You might seen this. Very frequently, you might seen this. If you've seen relative, when you're seeing price relative to value area, your point of control here, your ABCD would have been formed over here. A and B and C and D would have been formed over here. All in a sudden, middle of the day, the news would have been come, then market would have been reacted to the news. And everyone will be yelling like market is dropping and there'll be a serious media attention. Media will be talking about that news, but price will be doing something like price would have been stopped there and it will be doing something like this. And then it means reverts back. End of the day, it means reverts back. And everyone will be wondering why the market went up. So the players who is selling below the value area. So this is value area low, right? So this is value area low for the current day. That will be keep changing. But if they are not serious sellers, what happens? The price breaks, but more activity happens already in the fast. You will be seeing ABCDE or you will be seeing ABCDE balancing. The sellers who are selling down below here, we call them like short in the hole. Most of the time, the emotional sellers are coming and selling below the value area low. And most of the time, 80 to 85% of the time, they're going to get trapped over there. Very rarely we see a continuation in the form of double distribution. Right. So one of the things what you should not do is that you should never ever be part of this trade. So maybe your trade should have been somewhere already executed over here, or you see this and I mean, to keep it simple, you should not be part of this trade. If you are part of this trade, you are part of emotional selling activity. You're part of the emotional selling activity. Most of the times you're going to get caught rather than taking your trades. And market moving in your favor is going to be relatively low, right? Unless it forms a double distribution for the day. Most of the times you're going to get hurt yourself if you're going to initiate trades below the value area low or above the value area high. So that is not a good practice, I would say that. Mostly emotional traders take a decision who watches the price. Probably they do take an emotional decision because let's say this is my previous day low. And this is one more day's low. This is, let's say this is one more day's low. This is 2-day low. This is 2-day low. 2-day low. And price would be doing something else, like it does an ABCD balancing. And all of a sudden it breaks the 2-day low. It breaks the 2-day low. If they are serious sellers, they would have been doing more activity over here. But if that is not happening, instead of price is coming back into the range and it's coming back into this range, these are the signs that they're going to do a complete mean reversion. They're doing a complete mean reversion. You're going to get trapped most of the times. So I'm not saying that whenever the price is plunging below the value area low here, right? What you should not do is that when you look into the context, surrounding context, where the other lows are positioned, if it is breaking 2-day low, your expectation is that if you are on the sell side, your expectation is that more activity has to happen. That is a good continuation. If it is a bad continuation, what happens is that when the moment it plunges, it again retraces back. It immediately retraces back. So you have to, when the price is plunging down below the value area low, relative to previous day, what happens, right? So maybe if there is an 2-day high, is it breaking the 2-day high or it is breaking multi-day high? Relative to that, you have to take a trading decisions, which we will be explaining during live markets. That is why during live markets, we have a lot of live market studies we are going to do. We'll be talking about where the activity is getting built, how the day low is broken, and when the day low is broken, how we evaluate the market confidence, and many things we are going to talk about over there, right? And so these are some of the basic NinjaTrader TPO settings. This is a recommended TPO settings as well from my side. Not necessarily you have to follow the same, but these are optimal settings. The TPO size here, we don't use different TPO size for different instruments. I mean, we use different TPO size for different instruments because when it comes to something like Nifty, some Nifty comes in the band around this band, 5,000 to 30,000. Nifty and Bank Nifty both comes in this band. So the tick size is nothing but the basic minimal possible movement in Nifty or Bank Nifty. That is 0.05. Most of the softwares currently uses 0.05 for let's say the global data feeds or true data. They use the tick size as, they set the tick size as 0.05. Whereas for crude oil, it is 1 point. So based upon the tick size, you have to define your TPO. So the tick size multiplied by your TPO size is what actually gives the actual TPO size. So these are the software settings I have to make. Price per tick I have to set as 20. That 20 will be multiplied by 0.05, which is mostly supplied by my data feed provider, which I can also monitor from NinjaTrader. I'll show you how I can monitor from the NinjaTrader. So let's say I'll go back to the NinjaTrader. I'll go to tools, instrument. Here you can find lot many instruments. Let's say I'm going for Nifty futures. Nifty-I is my symbol, which is provided by my data feed provider. I'll go to edit. Here you can see that the tick size is 0.05. This is supplied by my data feed vendor. My data feed vendor is Global Data Feeds. Suppose if you're using a different data feed vendor, if they are saying 0.01, usually it is 0.01, then you have to multiply 100 with it. So if you want to set a TPO size of 1 point, you have to multiply with 100. But in my case, I have to multiply with 20, so that I'll get. I have to multiply with 20, so that I'll be getting 1 point TPO. I'll be able to get 1 point TPO. You're getting my point? So I have to multiply with 20 to get a 1 point TPO. So why I am sitting over 1 point TPO? That is very crucial here, because different people uses different TPO settings. It doesn't matter what TPO size you're going to use, right? So let's say for the same Nifty futures, over here, let me close this. For the same Nifty futures here, so here is the TPO settings, and if you compress, you'll be getting an information like this. So let me remove splitting and merging everywhere. Let's say instead I'll go to indicators. I right click, I'll go to indicators. And one of the settings which I'm going to control here is the TPO size block. By default, it is 20. That means 20 will be multiplied by 0.05. That is the tick size of the trading instrument. That gives you the actual TPO size. That gives you the 1 point TPO, right? That means as described in the PPT, I set 20 in my software. That will be multiplied by 0.05 of the instrument setting, which is provided by my data feed vendor, that will give me the 1 point TPO. That is the basic fundamental unit of market profile, right? Whereas if I want to set, I can set 3 points also. You might seen, if you would have been seen the other market profile players, some people might be using 3 point TPO, some people might be using 5 point TPO. So if I want to set 3 point TPO, I have to set 60. That 60 will be multiplied by 0.05, which becomes 3 points. I can play with this. Absolutely, there is no difference in that. So you see that the distribution remains the same. The distribution will not change much. You will be getting the same distribution. You'll be getting the same sort of distribution. You'll be able to get the same sort of distribution. You'll be getting the same sort of double distribution over here. Nothing is going to change. And in fact, you'll be able to read more information. You'll be able to read more charts. You'll be able to get more data points precisely. But why exactly I'm using 1 point is, let's say, take this example. Okay, this example, the single print zones are just how many points? Are some 4 or 6 or 7 TPOs are there. But in case of Bank Nifty, let's say I'm going to change my TPO size to 10. So that I'll otherwise what you'll see, you'll be seeing more information. You have to elongate, you have to stretch to your profiles. It's not readable. So many people, what they do, they don't want to go with a lower size. They want to go with indicators. You see this, I'm going to set 10 point in Bank Nifty. So every block is nothing but 10 points of trading activity. Before applying, you notice that there is a single print here. There is a single print zones here, which is very crucial for me. But if I am going to apply it, I might miss that information. You see that now on 2nd of Jan, now I'm not able to see that single print zones over here, which is supposed to be there, but now it is not there. The distribution is like a double distribution only, but the single print is missing here. So I'm not able to take the reference level from there. To take the reference level there, I need an optimal information. I don't want a too bigger number. I don't want a too bigger TPO size. I don't want a too lower TPO size. If your TPO size is very, very lower, let's say 50 paise TPO or 25 paise TPO, maybe it'll be too much of information for Bank Nifty. You'll generate too much of letters, too much of blocks. I don't want too much of letters. I don't want too less of information also. This is too less of information for me. This is too which I'll be able to miss some of the crucial information there. So in order to balance both, I need an optimal level where I'll be able to get whatever the information I want from the profile. I'll be able to track those double distribution levels or a triple distribution levels, which is very crucial for my trading decisions. I come up with a framework so that you can set for any price level, you can set the optimal settings in your software. So these are the settings you need to do it in your softwares. The 1 or 2 or 5 or 20. When it comes to Nifty, Bank Nifty, I use 20, or even for crude oil for the sake, you can use 10 for if you're going to use crude oil, because right now it's trading somewhere around 3,000 or 4,000 levels. And something like an Ashok Leyland or something, let's say if the stock is trading around 100 to 250, then you can use a 10 paise TPO. For every 10 paise, it will plot one individual letter. Let's say for S Bank. S Bank is currently trading around, where exactly S Bank is trading around? Let's say S Bank share price. So it's currently trading around 190. So as per the settings, what I'll be doing is that I'll be setting TPO size as 2. That means every 10 paise, it will be plotting an individual brick. So now let me show you how I'll be doing the settings for S Bank. So let me go back to the charts. Let's say I'll duplicate the slide, duplicate in a new tab. So automatically it opens Bank Nifty. If it is an, I'll open S Bank as well. So this is using a setting of 10 TPO. So 10 TPO, you see that your information will not be proper because it's too much of information. In a day, 10 points will not happen in S Bank. So you need an optimal settings in order to capture the single prints, all those short-term nuances. You need to set an optimal level. You have to set 2 here. So if you set 2 here, every 10 paise you will get a TPO. So now you'll be getting in proper information about that day, and you'll be able to capture those single print zones. You see that there is a single print zone at this period. So that information is very crucial to me. So I'll draw a line to draw my reference line over there. I put a marker saying that this is one of my reference level, which I am going to watch on Monday. So this is one of my reference level to monitor my confidence. So if, let's say, the price is plunging there, and if they are good sellers, they will plunge below that level. If they are not a good sellers, they will sell and then they will immediately roll back, and then market does something like this. So that's how I'll be positioned myself in the market based upon those single prints levels are there. So those single print levels are very crucial to me. I cannot miss this information. If you are using a higher TPO settings, let's say instead of on 1 point TPO, let's say here in this case I'm using an 10 paise TPO. If I'm going to use an 4 here, it becomes 20 paise TPO. Still that single print will be there. Everything will be there. This distribution will be same, but some of those reference level you can see here now. Now, if you look into the settings, there is only 2 TPOs are got rated. Still that single print is there. But still, if I go to the indicators, if I increase the numbers, I may miss that information. Let's say 10, that means 50, every 50 paise. If I'm going to plot that information, I might miss that information. So now you see that the information is missing here. The distribution is same, but you miss that single print information, which is very crucial for taking short-term trading decisions, is what very much required over there. So that is why I came up with a framework to get an optimal information. Probably these levels are optimal, and not necessarily if you're not if you're not comfortable with 2, you can move to 3 or 4 or 5, but you should be settled around this range to get a proper details. This will give you a finer details about those information, where you'll be able to see those mechanical reference levels. You'll be able to see those, you can visualize those mechanical levels. So whereas if you are using a very big TPO size, you may not be able to see those smaller details about it, right? So if you want to follow the Jim Dalton principles, you need an optimal TPO size settings. Whereas if you are using for Nifty 3 or 5, you may not be able to follow Jim Dalton's principles. That's what my learning so far, right? Yeah, so what we can do here is we can take a break. Of course, I took a little bit of more extended timing. So what I want you to do is, I want you to take a quick break and take your lunch and come back by 2 p.m. The session will start sharply by 2 p.m. right? And I can take questions around 2 p.m. If you have any questions, we can start the day with around 2 o'clock with questions, and then we move to the next topics.
Rajendra, just a question you can take up later, but just can you please share what is the significance of having 30 minutes later on?
Yes, sure. We'll start with that question. We'll start with that answering around. We'll start with 2 o'clock, right? First,
right.
Let's have a quick lunch, get back, and we have a lot of work to do. Thank you.